Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith and our executive editor, Brian Sazi. This is Yahoo Finance Live. Here is what we're watching this morning. Walmart beats the street on earnings, but shares slump on a cautious outlook for the U.S. consumer. Stock in the nation's biggest retailer had just hit an all-time high. We speak with CFO John David Rainey this hour.
And constructive and productive. That's how President Biden described his hours-long meeting with China's Xi Jinping, though there wasn't much in terms of concrete agreements. We are going to turn our focus to Xi's dinner with some of America's most influential business leaders.
And corporations are cutting back, according to Cisco. The company slashing its full-year guidance thanks to weaker demand from clients. But CEO Chuck Robbins says macro conditions are not to blame in this case.
We want to go to our top story of the day, and that is Walmart. Now, the retailer posting better than expected third quarter earnings this morning has also lifted its full year profit outlook for 2024. But shares are under a bit of pressure in pre-market trading after executives warned of near-term softness. Now, despite a challenging economic environment, Walmart's saying that inventory is still in, quote, good shape ahead of the holiday shopping season. We're looking at losses here of nearly 6% ahead of the open. When you take a look at some of these numbers within the report, it was actually relatively strong when you take into account customer transactions were up 3.4%. Average ticket was also up just about 1.5%. E-commerce sales, at least in the U.S., was a huge win, up 24%. Yet despite all that, looks like the street is focusing on some of the commentary in terms of what Walmart is seeing currently, and that's enough to put pressure on shares today.
Yeah, I think this was a bang-up quarter by Walmart, but this was a bang-up quarter that the market largely knew. Coming into this session, Walmart shares really at a 52-week high. You go through this quarter, tick by tick, e-commerce sales, U.S. up 24%, inventory down 5% in the U.S. business, margins up. Where the quarter, I think, is going to get dinged or is being dinged right now, pre-market, operating profits in that U.S. business down slightly year over year because of wage inflation. But at the end of the day, you take what Walmart put up today, same-store sales in the U.S. up 4.9%. Target reported yesterday, same-store sales down 4.9%. This holiday shopping season is Walmart's to lose. So I think that's why you're now starting to see the stock come back just a little bit from the worst here in the pre-market, because this was a very good quarter for Walmart. And I would even argue, guys, this outlook, it wasn't that bad at all.
Yeah, and considering the stock was already trading at an all-time high coming into this report, it just goes to show how much of a blowout report plus expectations would need to be raised even after the company had came out and delivered these numbers. And to what you said, Brian, a strong report. I think at the end of the day, though, it's important for us to remember that in some of those discretionary categories that are going to be squeezed as margins certainly come under pressure because of the heavy promotional and discounted season that we're going into, and some of that's already been pulled forward too. Walmart started off some of their days, their deals in early October, first week in October almost. So all that considered, it's important to remember that there's going to be that pressure on the discretionary categories. Think about electronics, home appliances. But then on the other side of this, it's important to remember that this is still a grocery store chain that has really strong other departments and aisles at the end of the day. They essentially have about 25% of the U.S. grocery market dollar share, 25.2%, based on some of the continued kind of analysis that comes out about the overall grocery industry. But grocery was the big call out here. And between Walmart and Sam's Club, they round out two of the top five here in that dollar share. So at the end of the day, comp sales solid at Sam's Club, led by food and consumables. And then additionally at Walmart US, you saw them cite strong sales led by grocery and health and wellness as well.
Yeah, and what is interesting here is that, and I think this continues to show the differences between these two chains. Sure, they're big boxes, they sell discounted goods, but Target has lost the narrative with the consumer in this country the past 2 years, and you've seen it in their results. And I know the market rewarded Target's quarter yesterday, stock up 17%, top trending ticker on Yahoo Finance. But when you think of saving money, you are thinking of going to Walmart first. Target is still seen as a trade-up experience. You walk into a Target, you get your cheap chic home goods, you get some other discretionary items that you don't need. In this environment, you are likely going to Walmart first to save money on groceries, and then maybe you splurge on cheaper home goods relative to Target before you leave the store. It's just the reality of it.
And I also think that some of the adjustments that Walmart has made over the past 3 years obviously really starting to pay off. When you talk about the investment that they have made to really boost their e-commerce business, we see right here within these results that pickup and delivery has been a huge win for Walmart here in most recent quarters. So when you look ahead to 2024, yes, the consumer picture is extremely uncertain. We talk about the fact that there's persistent inflation. We just got another reading on inflation earlier this week showing that once again, people continue to pay more for everyday goods. So if they are still spending on some of those more consumer staple type of items, they'll likely go to Walmart, like you guys were both saying.
Yep.
And then e-commerce really is giving Walmart a bit of an edge here when you compare it to some of their rivals.
My Gatorade's cheaper at Walmart. It just is. I
Everything is
don't
cheaper
price
at
compare
Walmart.
anything. It just is. It's just
That's
cheaper.
the thing that you decided to price compare?
That's the only thing. I mean, I go there for Gatorade.
It's
and
probably
hair
even
products.
cheaper at
Gatorade, are you
Sam's.
buying
What?
it?
It's going to say, I
Which
can't.
still Walmart owned.
It's just I don't have time for Sam's. But anyway, be sure to stick around for our interview with Walmart CFO John David Rainey at 9:35 a.m. Eastern Standard Time. You won't want to miss it. Really want to get a sense on how the holiday shopping season has started. John David will give it to us.
Yeah, we'll see what he says about grocery as well. Since I was mentioning grocery earlier, just to put a citation on that data that I was mentioning, that came from research firm Numerator, tracking some of that purchase data across the overall market share for the U.S. grocery division here. Also here, we're tracking another big name out this morning, another retailer, in fact.
Yeah, certainly. Let's take a look at Macys because it's another name that we have been focusing on here this morning, getting a boost from falling inventory levels despite a 7% decline in sales on a year-over-year basis. Now, the retail giant also adjusted its full-year outlook, now expects a sales decline of 7% versus a previous guidance of a drop of 7.5%. Again, we're looking at gains here in the pre-market action. When you dig into these results, yes, inventory levels did improve, fewer promotions, better inventory management, likely leading to the improvement that we are seeing in profit. But when you take a look at the gross margin number here, 40.3%, that was helped by fewer sales, same-store sales, fewer promotional activity. Same-store sales, though, still declining 7%. And it kind of also points to what we saw from Target earlier this week, right? When you talk about the fact that profit did heavily surpass Wall Street's expectations, yet when you look at declining sales, something that obviously is going to be a challenge here for many of these retailers.
Yeah, investors don't seem to care. They're ignoring these sales declines and really locking in, not just with Macys this morning, Target, and even, I would say to a lesser extent, Walmart, these inventory declines year over year. That is one of the biggest trends so far from this early batch of retail earnings. Saw it earlier in the week with Home Depot. These retailers are in a much better inventory position year over year relative to last year when there was an inventory glut going to the holidays, and there was a lot of discounting that really took a couple quarters to work through. But I look at this Macys quarter, and I've been very critical of Macys. It's under a $14 stock. It's just hard to imagine that. And I don't think it was that good at all. I look at the other revenue, and that is mostly comprised of their credit card business. Macys 3 months ago warned about rising delinquencies in their credit card business. Really would sound the alarm bell. Was a bad quarter for department stores. That business, other revenue for Macys, down $59 million year over year, really driven by just falling credit card revenues, consumers pulling back on what they're charging there. And then overall, like you mentioned, Shauna, sales down year over year. Discretionary purchases are just not being done. We heard from Target early in the week, people are waiting to the last minute to buy a coat. They want to see some snow, and if they do not see snow, they're not going out there to get a coat. They're reinvesting in maybe a great cheap steak at Walmart.
Yeah, the department store model is extremely fractured right now, and it's showing up in these numbers continually, time after time again. Macy's comp sales down 7.6% on a known basis. Bloomingdale's, which is the higher end, the luxury end of that, which starting to show some weakness there. Comp sales on a known basis down 3.2%. Own plus license basis down 4.4%. So all this considered at a time where we talk about it time and time again, going into that holiday season, how they're going to need to move through so much of the inventory that they've already taken on, that could come at an extreme loss.
Just staff your stores, Macy's. I go in there. I have a couple bucks to spend. I need a pair of socks. Show me some socks. I walk into Bloomingdale's. Nobody's even in these floors.
It's not a staffing issue. That's
It is
just
a staffing issue.
That's
It's
an
horrible.
issue of where they're putting the socks at.
Well, maybe they don't have any socks. Whatever it is, I want somebody to help me. And I think Macy's continues to do a terrible job to cater with the people with the money in the pocket that is going to these stores. That's a Macy's problem. We'll take that offline, as they say in Slack.
I think they do a good job, though, at Bloomingdale's. You got to give it to them. Yeah.
They do a pretty good job.
I like the
there.
Tom Ford
good
cologne
job.
section. It's pretty good.
It's a very good one. I put my headphones in when I shop. I don't want to be bothered. All right, we'll get Sazi a store associate pretty soon. Cisco shares are taking a hit this morning after the company saw new orders slow down in the first quarter and slashed its full-year revenue and profit forecasts. Executives on the earnings call did reiterate that the company's supply chain setbacks are now behind us. Shares of this company, you're seeing them move lower here pre-market by about 11%. Sazi, you're shaking your head with a wad of cash next to you. We'll get to that later on.
Can I just say it was just a shocking quarter from Cisco? Sure. I was really surprised. We just talked to Cisco CEO Chuck Robbins about a week ago about the AI initiatives that they brought to the table. But to hear them say, I think, voice some concern on the macro environment and people now working down that backlog that has been building up over at Cisco. This was a challenging quarter, and I think the street was really caught off guard. But I mentioned Chuck Robbins. We talked to him a couple days ago ahead of the results. Here's what he said about that macro economy.
There are a lot of dynamics in the world, obviously. We've got the interest rate pressure. You've got this emerging assessment of what's happening with the consumer. We've got geopolitical dynamics that have existed for a while. We obviously have war in the Middle East, war in Europe. And so there's a lot of unknowns, and I think we're just going to have to see how the next few months play out.
And overall, I think the reason why the street was caught off guard is because, again, that inventory that backlog that Cisco has been driving the past year is now starting to work down. But there was a lot of caution on this conference call about forward-looking demand and that macro environment, perhaps weighing on another quarter for Cisco. Maybe this is not a one-quarter issue.
Yeah, exactly. We heard that on the conference call here, saying that he almost expects this weak environment to linger just a bit, estimating that there are at least 1 to 2 quarters of the ship product orders that are still waiting to be implemented by its customers. So that points to further weakness here down the line. We know that Cisco has been under a bit of a transition story here as it does try to rely less on their equipment sales and push a little bit deeper into software and security. Clearly not enough progress being made at this time to offset some of the weakness or some of the headwinds that still faces their equipment business.
It's just a question of how they sell further into that existing client base too here. And even as you look kind of regionally to try and extrapolate on the revenue front where they are still seeing some successes, Americas was up 14%. Asia Pacific, that was actually down 3% there. And then product revenue performance, they saw growth in networking up 10%. But at the end of the day, for the number of products and services that they're selling into this core client base, how do you continue at a time where they're observing among those clients a propensity to say, you know what, our cost system right now, it works for us. We're not going to add on to that. And so that's going to impact to Cisco in this near term, because that means that you have a client that's comfortable with saying, you know what, we don't need the latest edition, or we don't need that add-on, and them pushing back on that. It creates a demand issue for Cisco.
I will add quickly, this I think it offers a good first test on how some of these AI companies, I would say on the fringes, are going to be looked upon by the market over the next couple months. Cisco's been driving a lot of forward or just a lot of bookings related to new AI initiatives for them. So I don't say there's any really read-through from Cisco to NVIDIA earnings in a couple weeks. I think there's just amazing demand for every single chip that NVIDIA puts out there. But just keep this quarter from Cisco in your back pocket as some of these other results come out.
Well, it also just lastly here, it is a time where they're still trying to figure out what this Splunk acquisition is going to mean for them too. That's not expected to close until midpoint of 2024, and so the street has been extremely judicious about how they're grading these acquisitions, even for some of the ERP companies that have a history of acquiring to grow.
All right, guys, let's get to our international story of the day. And President Biden and China's President Xi Jinping meeting for the first time face-to-face in over a year. This happened just by the APEC summit in San Francisco yesterday. Now, the two leaders spoke for about 4 hours. Xi walked away from the meeting seemingly optimistic, saying that it is not an option for the two countries to turn their backs on each other. He added, quote, planet Earth is big enough for the two countries to succeed. President Biden called the discussions some of the, quote, most productive that he's had with Xi. Let's take a listen to what he had to say.
I've been meeting with President Xi since both of us were vice president over 10 years ago. Our meetings have always been candid and straightforward. We haven't always agreed, but they've been straightforward. And today, build on the groundwork we laid over the past several months of high-level diplomacy between our teams. We've made some important progress, I believe.
So made some important progress. I think at least at first you would have said that the tone at the meeting was relatively optimistic, maybe a bit warmer than what we have seen in terms of U.S.-China relations in the past. But then there were some comments made by President Biden shortly after those comments were initially taken. And that could have unraveled things, maybe any of the progress that was made. And those were the comments that he said in regards to a question about whether or not Xi is a dictator. And President Biden said, quote, he's a dictator in the sense that he's a guy who runs a country that is a communist country that's based on a form of government totally different than ours. And I think those comments are what the street, what traders are latching onto this morning when you see some of the pressure in some of the U.S. Chinese listed names here throughout the morning.
Yeah, and some of those listed names were in attendance at the meeting yesterday and at this dinner, forking up $40,000 just to try and get some of that time and sit at the table with the Chinese president Xi Jinping.
They didn't take mine. I didn't take.
Well,
I mean, I had the paper
fortunately,
here. They didn't have it.
Don't worry. Hold it back up. Let the people show.
Yeah, I mean, I was ready to go. I was ready to put it down that table.
Ready to put it down in cash, too. Okay, so just going to roll up to President Xi. But at the end of the day, Larry Fink, CEO of BlackRock, Tim Cook, CEO of Apple, who his business, the Greater China business for Apple, is actually down year over year. I think it's sitting at about $72.5 billion versus last year, which was just a hair higher than that. But at the same time, all of these companies want to have the ear of the man, of the president, that ultimately is going to dictate perhaps how their business's success moves forward in a region that is outside of where their own homegrown name and their brand has evolved from for so many years here. And so with that being some of their growth strategy, of course, they all wanted to have that in perhaps, but there were some interesting photos taken too along the way.
Well, I just have to quickly acknowledge, and we're all friends here, I was watching Biden and Xi walk down that path. I wanted to see who was going to win the race, that walking race. I mean, full disclosure, optics matter in these types of meetings. Race. I was just very curious. See, look, I was actually watching this.
Do you think
yesterday.
they think about that?
Absolutely, most certainly, absolutely. Optics matter. Was President Biden going to let Xi beat him in this race down the path? It was actually something, and look, right there, you can see Xi pulling ahead, and you had the president kind of letting him pull ahead a little bit, maybe trying to cool relations.
But then he put his hips into it and tried to,
Yeah, and I think President Biden
What was the outcome, do we know?
I think President Biden actually beat him at the finish line. But nonetheless, like you mentioned, Brad, optics matter. And it was also interesting to see a good tweet from a friend of the show, Mark Benioff, taking an interesting photo with Elon Musk. There he is. A lot of capital tied up in that photo, of course. Mark Benioff, Salesforce co-founder and CEO, and Elon Musk, who runs, 18 different companies, maybe?
Yeah, safe to say that.
And then I think we had Xi with Golden State Warriors jersey there, so nice swag for Xi Jinping on his way back home.
Yeah. Well, he's doing everything he can to try to win back some of the foreign investment that has left China.
Well, he also lost that race down the path.
He did, yeah.
Wow, it was a tough path.
At least according to Sauce, he lost.
All right, guys, we'll be right back. We've got a little bit more to watch. Actually, as APEC continues in San Francisco, many investors still looking for exposure to the world's second biggest economy, even though China is still feeling the squeeze. For more on this, we've got Yahoo Finance reporter Jared Blickery to break it all down. Hey, Jared.
Hey there. Well, I'm taking a look here at the Nasdaq Golden Dragon Index, and we can see a lot of these stocks that are native to China and to Hong Kong are really taking a beating here. Alibaba, which was up 3.82% yesterday, that's the background. You can see in the early morning, we are down 8.18%. Pinduoduo down 3%, NetEase down 3%, JD.com down 5%, and the list goes on. So a lot of pressure here. Now, if I look at Chinese exposed stocks that are actually from the U.S., that are based in the U.S., there's a lot less carnage. Broadcom down 1.5%. NVIDIA derives a lot of its income from China, down 0.7%. Apple, huge in China, that's actually up 0.5%. So it looks like the domestic securities over there are having a more difficult time digesting all of this. And we've been talking about the foreign direct investment in China. That has fallen off a cliff. And first, I want to show you Chinese GDP, because this is their demographic. This kind of relates to their demographic time bomb. As their population ages, they have lower growth expectations. And if you're looking at this, we're talking about 3% in the long term. That is a far cry from the 10% that we expected a little more than a decade ago. And then on to the foreign direct investment, that has fallen off a cliff as well. This goes back to the early 2000s here. And you can see the line and these are the purple bars that I'm looking at. These are the purple lines that reflect direct investment. These have gone negative, so an actual reversal of that. Now, this cyan line right here is the interest rate differential between the U.S. and the Chinese bonds on the 10-year tenor. And what this is showing is because U.S. interest rates have risen so rapidly and to such a large degree, they're actually competing with China for a lot of the yield that investors around the globe are looking for. So China's lost out on a lot of business through its zero tolerance, no COVID policy. They didn't reopen as quickly as they wanted to. They've struggled to really kickstart their own stock market. And you take a look at KWeb, for instance, guidance. That's my proxy for what's going on over there. Let's see if I can find this here. And if I go to a year-to-date chart, that's going to be one of the bottom performers here, I believe. Well, anyway, KWEB down 4.9% for the year. Let's take a look at a 5-year chart. You can see peaked really early on in 2021. U.S. tech did something like this, and Chinese tech did something like this, the wrong direction. So there's a lot of still frosty relations between the U.S. and China, and we'll have to see where this all shakes out. But things are dicey. I don't think there's any way around that.
Things certainly are dicey. We're going to talk about this next hour with Brendan Ahern. He's actually the Crane Shares Chief Investment Officer, which runs the KWEB fund. So maybe he'll have a little bit more insight into how investors are looking at some of these opportunities. All right, Jared, thanks so much. Well, on the other side of the break, the opening bell on Wall Street. Plus, we're also talking earnings with Walmart CFO John David Rainey. He joins us next. Stick around.
All right, Walmart out with better than expected results, but we're seeing shares under pressure, some concerns about the company's outlook. Let's bring in really the man of the hour for us here at Yahoo Finance. That is Walmart CFO John David Rainey. John David, always nice to get some time with you. So market concern a little bit about the outlook. Are you seeing things in the business in recent weeks that would justify what the market is suggesting this morning?
Well, good morning, Brian. It's great to be on the show, first of all. I want to say we're really pleased with our quarter. We exceeded our expectations on both sales and EPS, and so I think our value proposition clearly is resonating with customers. But what we called out on the call was that we did see during the last 2 weeks of October some trends that were a little different than the first part of the quarter. We've seen consistent growth, pretty consistent each month of the quarter in most categories of our business. As we got into the back half of October, we saw that slip a little bit. And sometimes that can be related to unseasonal weather, could be related to other things that are happening in the economy. And so we called that out because it was a little bit different than what we've seen for the first part of the year. That said, as we look into November, and particularly around some of the events that we've had for our holiday shopping, we've seen pretty good strength. And so what that tells me is that the consumer is being discerning, maybe choiceful, and buying these more discretionary items, these larger ticket items, and they're leaning into these promotional or holiday type events to buy those items. And the shoulder periods around that are a little bit slower than what we've seen previously.
That change in sales cadence, John David, do you attribute that to student loans kicking back in October?
Well, that probably affects our business less than others, but there are something like 27 million Americans. I think it's roughly 10% of the U.S. population that are affected by student loans. And the estimates that I've seen suggest that that's somewhere between $5 and $8 billion a month in actual student loan repayment. So there's no doubt it has some effect. But you've also got some other things that are happening. We're reaching that point where we're about a year after the Fed has started tightening, and it's generally accepted that that's the period of time that it begins to take more an effect on the consumer. We're also seeing consumer balance sheets that are getting back to the level they were pre-pandemic. I think some of the resilience in consumer spending up to this point has been because of stronger balance sheets. So there's a lot of mixed signals out there. Overall, our business is performing well. We're seeing strong growth in many aspects of our business. In particular, when we look at November, month to date here, some of the categories that have been weaker year to date, apparel, home, electronics, we've actually seen strengthen, and particular strength in our marketplace business, which has double-digit sales in many of those areas. And so what that tells me is that customers are choosing Walmart. We're gaining share. They're coming to us for value and convenience, but broadly, there's some stress on the consumer.
John David, when it comes to some of those improving trends that you are seeing, I guess how optimistic are you that that can continue as you look ahead to 2024? And some of the relief maybe that you are starting to hopefully see on the consumer, what does the timeline of that look like?
Well, when we talk about relief on the consumer, I think the first thing that we need to talk about is inflation. We've seen high inflation for 2 years now. When we look at the month of October, broadly across the categories of our business, inflation is about 2%, so much better than what it was. And you actually have to look at that by category to really understand what's happening. So food and consumables tend to be in that 2 to 4% range. General merchandise is actually, we've seen a pretty sharp drop off just in the last couple of weeks, where that is deflating year over year. So prices are less than where they were a year ago, and actually getting pretty close to where they were 2 years ago. And so what the impact that's had on the consumer is they've had less money. Their wallets have been stretched more thinly because of higher prices. And so they've focused on those things that they need versus the things that they want. And so as that pertains to the period of time that we're going into right now, the holiday shopping period, they're waiting for these holiday specials, for these big events to buy those bigger ticket items, those TVs, those homes, and the home and electronic type categories that we're seeing stronger spending in. But I think everything else said, like, we want to see lower prices. That's good for our customers. We want to be able to pass that along to them. And I think the consumer needs some relief right now.
And John David, there has been that stretching of the sales period and some of those deals starting earlier on. I think Walmart, for its own, had started some of those in basically the second week of October. And so all of that considered, when you see kind of a pull forward of some of those deals and trying to get consumers in the door earlier on, perhaps delivering on some of those holiday orders that they would have made later in the season, how does that change the comps kind of year over year here now, especially when you're pulling perhaps the successes of one quarter into a prior quarter?
Yeah, it's a great question. So much of our business is dependent upon the holiday shopping period. The fourth quarter in general is about 20% larger for us. And to your point on Black Friday really is no longer a day, it's more of a concept. We at Walmart started our events on November 8th with deals for our customers. And even if you look at the period of time between Thanksgiving and Christmas, we have an extra day this year. That always distorts comps year over years. And so you tend to look at these things daily and look at the trends first thing in the morning and try to observe what's happening in the business. So we'll be watching closely over the holiday shopping period. But I think for us, we're really excited about the value that we're passing on to our customers. I'll give you an example. For the Christmas holiday shopping period, we've got 25 items, 25 toys that are less than $25. And so we want to lean into these special moments for our customers and members so that they can find the value and the items that they want at Walmart.
John David, thank you for finally sticking a fork in Black Friday. I've been saying this for the past decade. It doesn't even exist anymore. All these deals are coming out well in advance, months in advance in some cases. But before I let you go, are you just giving out open-ended checks on all things AI? I mean, I've seen some stories out recently on what Walmart is doing in terms of AI and how it might change your how your warehousing and how you deliver goods. How much in terms of investment are you planning for AI-related projects next year? And then can you point to one that is really going to change how you operate?
Yeah, well, I don't think any CFO is going to be saying that they're giving out open-ended checks on anything, but the returns around AI are really, really compelling. And probably the best example that I'll give you is for our customers. When they come shop us, we're able to present offers to them in different categories of merchandise that we can see other customers do similar things. That's a great way to get customers to come to us, to use our e-commerce channels, to buy the things that they want and some of the things that maybe they didn't even know they wanted when they came shopping for us.
John David, we always appreciate you taking the time to join us here at Yahoo Finance. John David Rainey, Walmart CFO. Thanks so much.
Thank you.
We've got to get to the opening bell on Wall Street, doing a quick check of the markets. Let's see how we are opening today. A bit of pressure here with the Dow and the S&P, both still in the red. The Dow off just over 100 points. Jared Blickery standing by at the big board for a closer look. Jared.
Yes, looks like we're still waiting for that opening print in the Nasdaq. Should be negative, and we're just tracking a little bit of weakness here. Let's go to the sector action, see if we can see what's going on inside the market. Here we have utilities. That's up 1%. Interest rate sensitive sectors have done really well over the past 14 days. In fact, let me show you what that looks like right now, because that's when this rally started after the October 27th low. So you take the close of that day into today, and we're looking at utilities. That is the #1 performing sector. Not surprising, because the 10-year yield has dropped from 5% to 4.5%. Then we have healthcare. That's defensive. Real estate, financials. Really is interesting to see what has been outperforming over the last few days, because as we know, it has really been the mega caps that has outperformed, and they're not doing badly. You look at XLC, that has Meta and Alphabet, that's up 10%, tech up 13%, and you take a look at the leaders here. I was writing about this in the morning brief. Just take a look at some of the leaders here. We got meme stocks up 12.9% over the trailing 4 days. It looks like disruption is doing well, Korean stocks as well. So a lot of the fringier stuff is just kind of making its way towards the top of this market. Now, let's get back to what's happening to today. Nasdaq, Apple up 1%, Nvidia down just a hair, Amazon down 2%. We've been talking about some of the Chinese exposed stock that we have here in the U.S. So let's take a quick look at that before we move on. And here we have that board. You can see there's Apple and Nvidia. And for some of the others, Intel up 1.3%, Texas Instruments up 0.5%. For the most part, not any disasters or big stories that I'm seeing there. Let's take a look inside disruption. I was saying that's one of the best performing sectors in this rally. Not today. Take a look at that. That is a sea of red. So maybe giving back a little bit of what has been gained over the prior 13 days. In fact, here's my entire leaders board, and KWEB, that is a Chinese internet ETF. That is down 5%, followed by crypto and gambling. So risk markets doing okay today, but some of them taking a little bit of a backseat, guys.
All right, Jared, we'll check in with you in just a bit here. Let's talk about some of the recent moves that we've seen in the market. The market rally coming somewhat off the boil this morning. Walmart's cautious tone on the road ahead, and Cisco's similarly downbeat comments weighing on sentiment. There's also geopolitical tensions on our agenda, notably the meeting between President Biden and President Xi. Stocks have been on something of a hot streak. The S&P up around 7% for the month. The Nasdaq doing even better. Let's talk about where things stand today. We want to bring in Jeffrey Kleintop. He's Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's great to see you here. So let's talk about some of the movement actually that we're seeing this morning, because a number of Chinese stocks here are under a bit of pressure following the meeting that we got yesterday between President Biden and President Xi. That nervous tone that seems to be coming out of Wall Street today, is that justified?
Well, I think stocks are showing some disappointment that there was no tariff talk at all. There was some thought that perhaps we might hear from the U.S. They might be looking to lower tariffs made on things like Chinese bikes sold at Walmart, but instead increasing them on strategic business spending areas in an attempt to lower CPI without appearing to let up on China. But we didn't hear about any of that at all, maybe pushing out the whole tariff discussion. And so I think there was a little bit of disappointment around that. But I think more interestingly, maybe the Biden-Xi meeting wasn't the big China news this week that might be moving stocks. Taiwan's two main opposition parties decided just before the meeting between Biden and Xi, that's the Kuomintang, which is China's nationalist party in Taiwan, and the upstart Taiwan People's Party, they both agreed to run on a combined ticket for January 13th's Taiwanese presidential election. Together, the KMT and the TPP would likely defeat the ruling pro-independence Democratic People's Party in that election on January 13th. Such a result would really please mainland China and diffuse maybe China-Taiwan tensions. I think that's an interesting undercurrent to all of this, the idea that Taiwan may have just moved much more closer to China, despite anything that could have come out at the Biden-Xi meeting.
And so it's about the meeting, but it's also about the dinner that these CEOs were paying $40,000 to get a seat at the table with President Xi and get some of his attention, knowing how much they needed to maintain favorability within that region as well for some of their own growth ambitions. How do they go back to their businesses, their investors, and say that $40,000 was worth it?
Well, you're right. I mean, they'll have to come back with something. I think this is the long game, right? We know China definitely plays a long game, and so do the businesses working within China. We did hear from, I think it was just a week or two ago, we heard from Stellantis, which struck a $1.1 billion deal for a stake in China's Leap motor. This was one of two recent deals between legacy auto giants and Chinese electric vehicle companies that really shows kind of a reversal in the flow of technology. We're used to Western businesses investing in China and then sharing Western technology with China. This is about the other way around, that there's actually some leading technology in China, particularly around self-driving vehicles and batteries and electric vehicle technology that the Western businesses want. And so we're actually seeing a back and forth there that's kind of interesting and maybe reversing the intellectual capital flow that we've been used to.
Jeff, if you're a U.S. investor and you've watched the optics from this event the past 12 hours and you're sitting on big gains, notably in the Magnificent Seven and those 7 large tech companies, what's your move into your end?
Yeah, I'm looking to broaden that. I want to look at the average stock. You know, one of the interesting things that's being masked by those Magnificent Seven is the fact that the average U.S. stock is underperforming the average international stock this year, including those stocks in Asia. I think that's important. Broader support in Europe, broader support across the markets in Asia is really interesting right now. That's where I'm finding more opportunities, lower valuations, companies that are braced for a more difficult economic environment, and one that I think we're likely to see in 2024. So I'm finding more opportunity there. I'd also note that there are a number of companies that might be at risk of shortages. We're seeing this El Nino effect in the Pacific really affecting transit. The Panama Canal authorities have announced last week they're further reducing the daily number of ships through the Panama Canal, where 40% of the world's cargo traffic flows. I think that could become a bigger and bigger issue, weighing on inventories and maybe even pushing up prices later this year.
Does the rally that we're currently in then, to that estimation, have legs beyond what we've seen thus far? And do we take out some of the highs that we had hit earlier this year?
I'm focused on areas like energy and financials, areas that haven't had a whole lot of excitement here lately. I know energy stocks have seen a little bit more momentum here on the improvement in prices, but I think that's where you're finding more solid near-term cash flow. I think you can see those continue to move up. Other areas of the market I'm a little more worried about, particularly the consumer-oriented areas, as we see maybe the labor market begin to soften.
All right, Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, always a pleasure to grab some time with you. Thanks for kicking off the trading session with us.
Thanks for having me.
Certainly. Well, is cash still king? Time for your crucial market commentary this morning. And for that, we go to Barclays. Strategists at the bank think that global stocks will outperform bonds in 2024 as they navigate a soft-ish economic landing. Joining us for the discussion, we've got Yahoo Finance's Madison Mills, who took a look at this note here this morning. What do we know?
Yeah, so it feels like a week of if you blink, you're going to miss a projection change. So I was interested to see Barclays kind of changing their tone here after 2 quarters of saying, like you said, Brad, cash is king. Now they're saying, actually, we're going to get into stocks here. It's time to have a little bit more risk, which is interesting even after we've seen a little bit of recovery in the 10-year. Having said that, they are saying it's time to get in on stocks. They're projecting single-digit returns in 2024, not double-digit, which I also found that skepticism from them a little interesting because the S&P already broke out of their predicted numbers for 2023, but having a little bit of that skepticism in their calls heading into 2024. And it's interesting, we've been talking about the Walmart earnings throughout the morning, guys. In their note, they said the market should look beyond any negative earnings and look ahead to the future with stocks, which feels to me like a look to NVIDIA earnings next week.
I mean, Sazi brought a whole wad of cash here on set with him.
Look, I
So
know
he
you
still
look
thinks
at
that
that.
cash is
I wasn't in studio.
I mean, it's just
What's
a lot
going
of
on?
cash because that's how we
We're all
roll
trying
here.
to figure out what's going on.
If Nvidia disappoints, and when they report in about a week and a half, that would send this market way, way lower.
Well, yeah, that's the catalyst for a lot of the AI hype, and that's
Well, that's why you have to pay
turned
attention
into
to
the
Cisco.
showman. Yeah.
Today with Cisco, I'm not saying they're direct comparisons, but if Cisco is warning about the demand environment, maybe estimates for Nvidia, maybe they're just a little too high next year, just a little bit.
Yeah, and then that would throw in question a lot of the outlooks that we're getting here for 2024 because we know so much of those gains obviously based on the performance of tech driven by NVIDIA, something we've been talking about now for feels like forever, but at least the last 10, 11
No,
months.
it's forever.
It feels like forever. Yeah, exactly. So, I mean, how much then is that going to change? We certainly have seen strategists revise their outlooks time and time again, especially this year, given all the uncertainty. And as we look ahead to the setup into 2024, there's still a lot of investors out there kind of scratching their heads at exactly what the Fed is going to do and exactly then what that means for equity returns next year.
Right, and they're continuing to look for that breadth outside of mega cap tech names. And I saw this morning that hedge fund investment in mega caps is in the 99th percentile. At the start of the year, it was in the 12th. So we're seeing a lot of diving into these tech names because how long are you going to wait on the sidelines and say, that's bad if we're going all in on 7 names, but I also have to show returns at the end of the year.
Yeah. Wow. All right, well, Madison Mills, always great to have you here on set. Thanks so much for breaking that down for us. Well, as if it wasn't tough enough to make it through a Thursday, some have had to do it without their morning coffee. That's a tough thing to do. Starbucks employees at more than 200 locations nationwide walking off the job today, striking workers, saying that they're taking a stand against what they're calling understaffing and overwhelming mobile order volumes, especially on promotional days like today, Red Cup Day. We know that this is a very important day here for Starbucks, just in terms of that promotional activity. More people are expected to try at least to go and get their daily coffees from Starbucks, given that promotion. I won't name names, but one of our producers was a little bit upset.
I think she's about 80 bucks a
worried.
day. She's about 80 bucks a day. Oh, not that producer. We have a big team.
There's a lot of Starbucks loyalists here, but this just speaks to the larger issue that has been plaguing Starbucks now for quite some time. Obviously, many of their workers very upset with the current terms of pay, benefits. They want to see changes. Starbucks has been routinely pushing back on that.
They should stop letting people order unicorn frappuccinos when they go in there. I mean, I, for myself, have gotten a s'mores frappuccino, a Barbie frappuccino. I mean, this is
You're
all
part of the
awful.
problem, then.
I mean, I don't get it frequently, though. I only get it when everything else is closed because we know I support local business. But at the end of the day, I think it still does come back to a lot of people who have now had this as a daily part of their routine. And Starbucks has done really good at making sure that the rewards customers continue to buy into this experience, this ecosystem. But where's the benefit for some of the workers that are on the other side of that, too? And then Starbucks, for its own, has done pretty well in touting some of the benefits of being one of the team members there, one of the partners, as they call them. You're shaking your head now.
I shake my head because Starbucks management, new CEO in there, we'll call him Lax, they continue to ignore this issue. This has been going on for well over a year. They think it's going away. Newsflash, it's not going away. At some point, you're going to have to address the demands by these workers. And to your point, Brad, they have really strong, I think they have a strong case here. They're asking workers to make drinks, incredibly complicated. They're having all this done now on mobile devices. The speed at which they have to create these drinks is just through the roof. And they want to do a Red Cup promotion. Starbucks has to do a better job of this. And it's not just cutting a bigger check to employees. It's actually giving a damn.
Well,
just going to say it.
I mean, and at the same time, too, they've, in some capacities, cut down on the number of employees that they keep on shift, which actually makes it even harder to deliver upon some of those customer demands, especially when you know that there is that much more volume that's coming in via mobile, as well as the people like me who, if I do go into a Starbucks, I'm standing in line waiting longer for my bacon egg bites to come out. I had to walk out one time, and that was in Times Square. That's a very radical type of experience that you have in there. But that aside, it is a life-changing
crowded
indeed.
possible location.
I mean, Maddie,
Brad.
you're here with us too.
Yeah.
I mean, would love to know your kind of vantage point on this. The workers definitely have the green siren, caught with the tail split right now.
I just always think about whenever I talk about union strikes. A couple of years ago at Milken, I saw a panel where they talked about how the number one lesson CEOs need to learn right now is how to handle union strikes, and that has totally proven to be true. This is the story of labor for this year and kind of 2022. Certainly going to be the story moving forward for a lot of these company names. So to your point, Brian, they have to figure this out because it's not an issue that's going to go away, not just for Starbucks, but for every company.
And it's just going to get worse. It seems like it's still spreading. And if you're modeling out the 5-year earnings trajectory of Starbucks, you better factor in more of these stores potentially becoming unionized and the cost of business going up a lot higher. And then and off of that, your drink is going to be a lot more, Brad. Maybe it's a $10 frap. I don't know.
My drink is not more. You guys know I don't go there every day. Like some people who
you
were
go
walking
there,
in.
though.
A lot of
I think you're a
backtracking.
frequent
There's a lot of backtracking.
When there are no other options, I will
goes
go
when there are
in.
no other
Keep the heat on them,
options.
Shauna and Maddie. Keep the heat on them.
We have people cursing the sky when they walked in this morning because Starbucks wasn't open.
Yeah. You
It's
know,
not me.
I'm fine with my $2 coffee from the cart guy right on the street. It is the best coffee, I think. It
a New York
blows
cup.
away the $7 cup of coffee that you're paying for.
Well, thanks for hooking us up this morning.
That's a New
Appreciate it. You got no
Yorker,
coffee,
too.
Shauna.
I'll treat you guys, and maybe someone will eventually come over to my side. I've been the biggest proponent of it now for some time. You're
Okay.
up.
I am up. All right, big stuff happening here later on Yahoo Finance. I'll be speaking to Transportation Secretary Pete Buttigieg. We're talking about the bipartisan infrastructure law 2 years later of today's anniversary. Catch that interview in our 3 p.m. show later today. We got much more coffee chat on the other side of the break.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Khemlani. America's obsession with weight loss and diabetes drugs has tipped the scales this year. Pharmaceutical companies like Novo Nordisk and Eli Lilly are cashing in on these newer drugs in a class known as GLP-1. That could have implications in other sectors for years. Meanwhile, new innovations like CRISPR are having their moment too. So what stocks are hot this year? And how did the healthcare sector perform overall? Joining me as part of Yahoo Finance's Healthcare Week to answer all of that is Jeff Mecham, Senior Analyst at Bank of America. Jeff, great to have you on today. I guess the first—
Hi, Anjali.
The first question, I guess, is going to obviously have to be Vertex because they just got approval in the UK for CRISPR. What a momentous occasion. How do you think that this impacts not just the stock, but really the entire class of therapies for next year?
Yeah, great to be with you. Thanks for having me. Yeah, for sure. You know, the news of the day is obviously the approval of the first gene-edited product for sickle cell and beta thalassemia. It was in the UK, but I do think that later on this year, beginning next, we'll get US approval. You know, the data for this drug is really remarkable. The big question, though, is, you know, the commercial piece of it, right? So pricing, reimbursement, access. Given that it's a novel technology, and I think the price point's going to be something in the million, 2 million plus. It's just going to take a little bit of time, I think, to really ramp from a commercial standpoint.
Absolutely. And to your point, still awaiting that U.S. approval. Meanwhile, of course, the other story this year that has really been big is the GLP-1s. And with that approval of Zepbound, this new now weight loss class of drugs has been a pretty big topic of conversation. We've seen Novo enjoy a significant market share this year, as well as, the cost of it coming into question and coverage. It's been quite a tumultuous year in that space. How do you think that this plays out for not just for the company, but for Lilly as well?
Yeah, you're totally right. It's been a remarkable year with respect to GLP-1s. I mean, it's probably about 60, 70% of my conversations every day are on GLP-1s. And it's not just with, healthcare analysts and portfolio managers. It's really consumer folks as well, right? Looking for read-throughs from everything from Walmart to, Coke, et cetera, a lot of consumer facing brands. I still think next year, it's still very, very early innings with regard to adoption. You mentioned Lilly Zepbound, so that was just approved. And so the question will be, what does reimbursement look like? What does access look like? Obviously having the SELECT trial from Novo's drug Wegovy this past weekend, I think will be a big help. But, I think that's going to play a role maybe sometime in a 25 standpoint when you think about, broader, reimbursement and access through CMS like Medicare, Medicaid.
And we also know, of course, the head-to-head trial that was announced. So that should be really interesting to watch for. And Lilly also providing that lower cost point for Zepbound. All really interesting. And to your point, you've definitely spent a lot of time on this year. You were one of the ones who had a lot to say about what the impact will be for other sectors. We've seen a little bit of pushback on that idea, that it might be, the sky is falling essentially for other food areas, food and beverage. What do you think now, a couple months out, seeing, to your point, the sort of limited patient population that has been impacted so far? Do you still think that this is something that has a long-term, broader impact for other sectors?
I would say I think it will have a long-term, broader impact. Things like, everything from food, beverage, apparel, even med devices. But what I would say, though, is that the next 1 to 2 years, I think should be fine. It should be a normal, market as the GLPs roll out. And all of our conversations, it really ends up being, how many folks are going to be on drug, mostly in the U.S. And, we have about, one or so on these GLP-1s officially for diabetes today, for obesity today. But if you get to 5 million, in a few years, and that starts to move the needle on, things like volume assumptions. And at the end of the decade, when we have, 25 to maybe 50 million people in the U.S. that will have seen these drugs, that does, really have a pretty significant long-term impact. But the next couple of years, I still think it's about the rollout and initial adoption.
Absolutely. And certainly seeing the long-term use is also part of that equation. Tell me about the sector overall. Healthcare this year has had an interesting ride. Aside from GLP-1s, what would you have to say about how the sector performed this year?
We started this year, it's interesting, really worried about rotation into technology, and that turned out to be, pretty accurate. I mean, we stuck with the higher growth names as our favorite stocks. So, Lilly and Merck, are the two of the faster growers in pharma. Vertex in a mid-cap BioMarin in the biotech end of things. And those are still names that we're sort of sticking with here. I just haven't seen a lot of interest in the value kind of stocks that, are or maybe have a revenue or earnings declines on the back of patent expiration. So it's been a tougher year for the, Pfizer's and Bristol's and AbbVie's of the world. I don't know if that necessarily changes next year, right? I don't think people are going to be digging into, value stocks and kind of turnaround stocks quite yet. I still think that, growth is going to be, mostly in favor looking to next year. And just stocks that have a real story, a real narrative, and clearly GLP-1s are just dominating that today.
Definitely. Well, we'll definitely have to see how that plays out through the rest of the year and for next year, what the topics will be of interest. I'm sure we're certainly going to see a tale from this year. Thank you, Jeff Mecham, Senior Analyst at Bank of America.
Thank you.
Coming up, Congress ends the threat of a government shutdown. Now the bill heads to President Biden's desk. We'll check the vibe in Washington next.
The new government funding bill is officially heading to President Biden's desk. The Senate voted 87-11 to move the bill forward ahead of Friday's deadline. The short-term agreement, however, only gives Congress a few months to come to a longer-term solution here. And so now, as we continue to march towards January and then again, once in this latter continuing resolution, February, we'll see exactly where some of the more kind of contentious elements of this debate will continue to move forward as well.
Yeah, this essentially just kicks a can down the road. And in 2 months from now, we're going to be having the same sort of discussion in terms of what the GOP wants. They obviously want more extensive cuts in terms of the funding and spending plans compared to what the Biden administration laid out earlier this year. But I think this really shows that the GOP felt some pressure. They didn't want to be blamed for a shutdown ahead of 2024. They were able to kind of come to an agreement here, agree on this short-term plan in order to keep the government funded and look ahead to maybe some of the negotiations or some of the hopefully, at least from their point of view, as some of the things that the Democrats would maybe be able to come to some sort of an agreement on in terms of what they see, what they would be willing to give into versus not. But again, it's more of the sticky points when it comes to funding going forward, when it comes to building wall, when it comes to immigration. Those are the sticking points that many of the far right leaning members of the Conservative Party were taking issue with when you take a look at the plans that were put forward by McCarthy several weeks ago, and then still not included, obviously, in the plan that was just passed this week. So looking ahead, we're going to be having a very similar sort of conversation, whether or not the GOP is able to get any sort of restrictions in place for spending that they want will be tough, given the fact that they have such a narrow leadership in the House and Senate, obviously still controlled by Democrats. But we'll see whether or not they're able to make some sort of negotiation agreement.
Yeah, just trying to kind of pass this through to what the markets might think of this as well here. The markets perhaps could look at this as, and this attempt and ultimately being able to get this to the president's desk, get it signed, and then ultimately, even if we are just kicking the can down the road, still looking at this as the potential in the future for this to perhaps be a sideline type of issue that doesn't drive the VIX back to the high teens like we were at when we were getting towards the deadline back in October now. And so all of that considered, perhaps the markets can look at this and find at least some sigh of relief that maybe it won't be as much of a continued, and these things continue to always come up again and again and again, regardless of who's in the office, who controls the balance of power. But at the end of the day, if the markets can sideline this as a headwind risk, potentially we'll see a little bit less volatility on any continuing negotiations that need to take place.
Yeah, and it seems like at least this time around, many investors were looking past this potential deadline, right? We talk about the fact that this is a subject that has come up time and time again. Markets almost seem used to it. They weren't too worried about the fact that maybe we wouldn't be able to get an agreement before the deadline tomorrow, but certainly we have gotten an agreement, but we're going to be having the same discussion before January 19th. All right, keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith in New York City. We're just about 30 minutes into the trading day, and let's take a look at how things are shaping up. A bit of a different picture here to how we started the morning, at least. The S&P back in positive territory, just barely above the flat line, up about 0.1%. You can see the Dow still under a bit of pressure. The major averages a bit muted this morning. This comes after a roaring rally that we started the week with. Disappointing guidance from Walmart also weighing on market sentiment.
We're also jumping across the pond to take a look at shares of Burberry. The luxury trench coat maker tanked this morning as its second quarter report showed comp store sales growth slowed to a meager 1%. That's down 18% over the quarter, and that weak demand makes it nearly impossible for Burberry to hit its sales forecast. Despite this, the management in the company said it's making good progress on its strategic aims. Shares down 9%.
We're also keeping an eye on another retail name, and that is Gap, set to release its third quarter earnings results after the bell today. Now, the retailer has seen 3 upward revisions over the past month on its revenue estimates, but investors may be a bit wary in terms of consumer spending and exactly what that could mean here for the retailer and its top line.
And we heard from China's e-commerce giant Alibaba. Shares plunging right now by about 7% after the company scrapped plans to spin off its cloud unit. The tech giant cited recently expanded U.S. chip export restrictions as the reason, saying it makes it tougher for Chinese companies to get the chips that they need.
Well, President Xi Jinping was in San Francisco this week meeting with President Biden in an effort to ease tensions between the U.S. and China. Now, in talks with President Biden, Xi raised the issue of sanctions and export controls in the U.S. that the U.S. has put into effect. And now things were left as is, with Biden announcing no plans to consider removing these efforts. Now, Alibaba is saying that these export controls on advanced computer chips, which were expanded in October, are hurting their business and has forced the company to abandon plans to spin off its cloud unit. For more on the business impact of the sanctions, we want to bring in Brendan Ahern. He's CraneShares Chief Investment Officer. Brendan, it's good to see you. So you're the perfect person to talk to about this. Obviously, with K-Web, with CraneShares, you have a pulse of what's going on, how investors are looking at some of these U.S.-listed Chinese names. In terms of the announcement that we just got from Alibaba this morning, how worrisome is that going forward?
Yeah, it's interesting because yesterday we had Tencent report that they had stockpiled several generations worth of semiconductor chips in advance of U.S. export controls. So it is an interesting move from Alibaba. I think certainly they're very transparent. They're very honest about their business and this potential challenge. And I think it leads to some necessity for clarification from the U.S. government on how exactly are they defining the small yard with high fence. And it's interesting that, as much as we're talking about, Alibaba, but, we're not really seeing U.S. semiconductor companies react, despite China being a very, very large source of revenue for many of these companies, such as a Qualcomm, which, 2/3 of their revenue is coming from China.
So how much of a viable portfolio play is this still, while that is perhaps, at least as Alibaba is citing, one of the kind of headwind concerns?
Yeah, Alibaba's decision to spin off the 6 underlying companies, the 6 different business units, was to force some of the parts analysis on investors that they believe that the company is very much undervalued. And they were going to force that analysis on investors by spinning off these underlying companies. So by putting that on hold, some of that I think is due to market conditions. Just the China, Hong Kong market has not had a great year. So it's not a great environment to be doing spin-offs and IPOs. I do think it's very positive the company is doing its first dividend ever. That really proves out their very, very strong cash flows. The company's got $60 billion worth of cash on the books, and a dividend is a strong move from management.
Brendan, when it comes to the meeting between President Xi and President Biden yesterday, the tone, at least initially, seemed a bit warmer between the two sides. From an investment perspective, are you at all optimistic that maybe we could see some relief in the tensions between the U.S. and China?
Yeah, clearly all this year, the Biden administration is looking to reset the relationship. We've seen, Blinken, Yellen, Kissinger, Kerry, Raimondo all traveled to China. Senate Majority Leader Chuck Schumer and 5 other senators. So there's clearly a effort to stabilize the relationship. And I think there's really strong progress from the 4-hour meeting around further military communication, which is obviously vitally important, but also addressing the issue of fentanyl agreements, exports, stopping that from China, which would be, very, very positive move.
If there is a solid move that comes forward between the two entities, the two largest countries by GDP in the world, when you think about who would be the immediate beneficiaries, either via tariffs that get rolled off or even by some of the intellectual property kind of tie-ups that have ultimately led both of these countries to say to the entities that operate within them, hey, you can't do business with anybody and sell a specific type of chip into this region. Who are the immediate beneficiaries in that instance if we do see some of the tit for tat start to roll off?
Yeah, I think it's a great point that, this kind of juvenile tit for tat, it really jeopardizes the very strong economic relationships, vitally important for U.S. farmers. China is the largest buyer of U.S. agriculture for U.S. semiconductor companies. But look at Apple, right? 20% of the revenue, Tesla, almost a quarter of the revenue. ExxonMobil, more than 10% of the revenues coming from China. So corporations have been getting along with one another quite fine. It's really diplomatically, we've had a strained relationship that, really, during COVID, you had COVID babies, but you also had COVID divorces. And unfortunately, the U.S.-China diplomatic relationship went through a little bit of a divorce, and now we're in kind of proverbial marriage counseling at the moment.
I like that analogy. Brendan, give us a better sense of what exactly is going on with China and its recovery in terms of the latest data that we are getting out of China showing that it's holding up maybe a bit better than some had feared up until this point. What do you think that then looks like looking ahead to 2024?
Yeah, I think it's always important investors recognize that the last recession in China was in 1993. So this apocalyptic collapse of China, I think it's a false narrative. At the same time, China is having a very, very slow recovery coming out of the removal of zero COVID. This proverbial scar tissue, the effect that zero COVID policy had on consumer confidence, consumer spending is incrementally, very slowly unwinding, but it's really led to this tepid recovery. Yes, it's a recovery. It's just not a pull the Band-Aid type of situation or flick the light switch where the economy is just back to normal. It's happening very slowly due to this scar tissue on zero COVID.
Brendan, really great to get your insights and analysis on this. Brendan Ahern, who is the Crane Shares Chief Investment Officer. Appreciate the time.
Thank you.
Thanks. Coming up, new leadership at the helm for Fox and News Corp. What Rupert Murdoch's departure means for cable news heading into the 2024 election. Next, we've got all your markets action ahead.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance. Shares of NVIDIA relatively flat this morning. The stock recently snapped its hot streak, touching overbought territory for the first time since July earlier this week. Joining us now with more, we've got Yahoo Finance's Jared Blickry standing by. Hey, Jared.
Hey, Brad, let's take a look at NVIDIA stock today. As you said, a little bit of a downturn here, but over the last 3 months, it's been trading sideways, and we can see after it reached the bottom end of this trading range, 390 down there, 10 days in a row was it up, and then it stopped, not coincidentally, right by where it was heading on its earnings day, its last earnings day. That was its record high, 499 and change, and it sold off there. So if you take a look at a 6-month, you can see the consolidation pattern here, and even better on a 1 year, it's just been camping out at these highs in a trading range, and should, when we have earnings next week, next Tuesday, should it be able to punch through this, who knows how far it will go. You can see over the last year up 200%, the number one stock in the U.S., at least as far as the large caps are concerned. I do have, here, let me do this. I have been talking about this 14-day rally here, and you can see in the semiconductor space, it's really been tech-centric. NVIDIA up 20%, one, or if not the largest one here, biggest gainer. Lam Research also up about 20%, AMD a little bit more, 23%. But let me just put a chart up of the last 5 years, and we can see what happened over the pandemic. Pretty impressive, right? You can see after the high in 2021, retreated a bit. A lot of stocks had a difficult time last year, but it's been off to the races ever since. Now, let me just generalize and show you what's been happening with U.S. tech versus China tech. This is also over 5 years. China here, and I'm using the Crane Shares China Net KWEB ETF here as a proxy. You can see that peaked in early 2021, while as U.S. tech, where I'm using the QQQs here, peaked later in the year. But while the KWEB actually took a huge decline there, still down something like 70%, 60%, don't quote me on that, American tech, U.S. tech was able to find its footing. And only today we got a record high in XLK. That is a large cap tech ETF. So let me just go back to NVIDIA here. I do have an earnings preview for next Tuesday. A couple of notes here from Bloomberg Intelligence. One of the things influencing the stock is the China curbs. There's $5 billion at risk in 2024. But one thing that Bloomberg is noting is NVIDIA has the ability to quickly design new China-specific products combined with high demand in the rest of the world, and this is going to mute, perhaps, the impact of the most recent U.S.-China restrictions on its 224 top line. So what this means is they are able to get around the restrictions in a legal way and produce new chips, and that nimbleness is allowing them to adjust, whereas other competitors haven't. And I'll just tell you this, we were talking about, I'm going to do a deep dive on Alibaba. Baba has foregone spinning off its cloud division here because of these very curbs. So it's not only affecting U.S. companies, but companies abroad. The bottom line, NVIDIA has been flying high, and it is poised to finally break out of this trading range it's been in for a few months. Just need that catalyst.
We'll be waiting for it. All right, Jared Blickry, thanks so much. Well, Rupert Murdoch stepping down this week as chair of News Corp. His son Lachlan heading in to take over. But Murdoch doesn't intend to jump into full-fledged retirement, telling shareholders yesterday that he plans to maintain a, quote, active role in the company. He will become chair emeritus of both Fox and News Corp. Fox News is perhaps his most enduring legacy. The conservative network forever changed the media's coverage of politics. So what can we expect from a possible Biden-Trump rematch in 2024? Brian Stelter is the author of the new book out, Network of Lies, the epic saga of Fox News, Donald Trump, and the battle for American democracy. Brian, congratulations on the book. It's great to see you.
You too, thanks.
So let's talk about where things stand today. We have Rupert Murdoch essentially stepping down, handing over the reins to Lachlan. When you take a look at the role Fox News has played in recent elections, specifically in 2020, what can we expect? What are the next steps, do you think, as we look ahead to 2024?
Right. One of the things I learned while doing this research for this book is that in 2020, Rupert and Lachlan Murdoch really were hands off when it came to election coverage. They did not meddle in Fox's decision desk. They did not, contra to the fears of liberal activists, they did not put a thumb on the scale. But once Fox did accurately call the election for Biden, some of Fox's opinion hosts swamped the truth with those lies about voter fraud and Dominion. Of course, that's what led to Dominion suing, and there's still another big lawsuit coming from Smartmatic. So we're going to be in a situation in the 2024 election where there is still a lot of litigation of the 2020 election. And I do think that might cause Fox to be somewhat more careful, more cautious about promoting lies in favor of Trump. But let's be honest, Fox News is more of an anti-Democrat machine than a pro-Republican machine. So at the end of the day, no matter who the GOP nominee is, whether it's Trump or anybody else, Fox will be on Trump's side because that means they're against Biden.
Has any of how that news is delivered changed, given that there's so much more effort put around making sure that if people are cutting the cord or if they're not utilizing linear networks the same way that they are, that at least maybe they're catching them on the streaming side? And how does that change even the way that they're speaking about some of the very kind of election sphere matters?
I think the biggest problem Lachlan Murdoch has as he officially takes charge of these companies, and we should acknowledge, he's been moving in this direction for years. Rupert has chosen Lachlan and signaled that for years. This week really makes it official, and it'll be official tomorrow at Fox Corporation. Lachlan Murdoch's biggest challenge is that the audience for Fox News is old and getting older. The average typical viewer is 65 or 70 or 75 years old, and they are still tied to cable. When Fox News has tried to expand into streaming, knowing that that's where everything's heading, they've had some only limited success. I reveal in the book that this 5-year-old Fox Nation streaming service only has about 2 million subscribers. In fact, they might not even hit 2 million quite yet, but they're hoping to by Christmas. That is a pretty minimal performance, given what you all know about the streaming wars. So it's been hard, basically, to convert Fox News viewers who are older into streaming, but that doesn't mean Lachlan's going to stop trying. He has Tubi and other streaming investments so that he is hedged in this marketplace.
Brian, how responsible, do you think Fox News is, the fact that Trump once again is the front runner in 2024, just given the coverage that they have paid to the president over the last, obviously now for quite some time, but specifically over the last several years? I guess how much has that influenced the 2024 race already?
Well, Rupert Murdoch, right after January 6th, said in private emails that we're going to make Trump a non-person. He said, we are pivoting away from Trump. He basically thought Trump was ruined. And so did Fox's biggest stars. Tucker Carlson on the air said, Trump is elderly and retiring. So there was this assumption that we were past the Trump age. But then I think what happened is Trump was replatformed. Conspiracy theories about January 6th made it easier to bring Trump back into the fold. He's now back center stage. And that has a lot to do with Fox. And now this rematch, gosh, I don't know. Does anybody watching this right now really actually want a rematch between Trump and Biden? I think the American people are yelling loud and clear that they want something else. But because of the incentive structures of these two parties, that's the direction we are heading in. And if Lachlan Murdoch could change it, maybe they would. But they always seem in this environment to be passengers, not leaders. People think about Rupert Murdoch as this swashbuckling media mogul who controls media companies and has influence all around the world. There is some truth to that. But when you read his emails the way I did for this book, you get the sense that he's a 92-year-old grandpa who just likes hanging out and reading his newspapers and enjoying his yachts. He doesn't seem to be as in command as he used to be. It doesn't seem like he wants to be picking and choosing candidates the way he used to for decades.
Yeah, and I think ultimately when it comes to the next election, nobody wants to watch two men take 10 minutes to walk 10 feet out to a debate stage lectern at the end of the day, too. Ultimately, as we move forward and really kind of consider the larger spate or the larger kind of weight that media still carries and how they're going to be looking for advertisers to advertise against and around some of the larger messages that are going to be coming out during the next general election. How has that kind of stacked up? What are the anticipations that are going to be driving not just Fox, but a lot of the networks and the revenue base that they're expecting to come in during the next major political cycle next year?
That's right. The debates fueled by Trump in 2016 were serious, profitable events for these networks. And not just debates, campaign ad spending has also fueled these broadcaster companies like Fox Corp. That's a big priority of Lachlan Murdoch's, making sure that campaign ad spending continues to come in. But I think, the reality is, because so many people are exhausted by this election, so many people feel politically homeless, I think that has an impact on the bottom line. The ratings for the Trump-free debates are not nearly as high as the ratings for the very Trumpy debates in 2016. So there are going to be impacts, at least around the edges, around the margins for these networks. But I still think big picture, political news is what drives CNN, MSNBC, and Fox News. It's what drives the bottom line. Not every day. Obviously, there are times when wars and other crises are center stage, but it is largely politics, and that's not going to change in 2024.
Brian, I'm curious to get your perspective on this. When you take a look at the role of Twitter, now X, under Elon Musk, we talk about a lot about the fact that we've had misinformation, disinformation tied to elections, recently tied to some coverage of wars here. How has Musk reshaped, has he at all reshaped maybe the approach that some media is taking to larger coverage events like the election, like the wars? And I guess, how dangerous do you think Musk potentially is, given the role that he now has at X?
Look, I think we're in an environment that is very destabilizing, where the richest person in the world is telling people, don't trust the real media, don't trust the real news, come over to my platform instead and believe whatever algorithm, whatever tweets pop up in your algorithm. Sorry, I know we're supposed to call them posts now, but they're always going to be tweets to me. I think Musk's message is that he can replace the real news media with this citizen journalism. And maybe that's a great dream 10, 20, 30 years from now, but it's not true today. What you see in that feed is a lot of nonsense and a lot of noise mixed in with real news. But I think that's actually an opportunity for media companies, for journalism outfits. It's to draw people back home, bring them back to a place that, look, a place like Yahoo, for example, a place like CNN, where I used to work. We're not perfect. Places like this aren't perfect, but we're trying. We're trying our best to get to what is real and true in the world. We're not just relying on a random assortment of messages and posts from who knows where, who knows who, in order to figure out what's true. Basically, I'm trying to say that role of journalism, those basic functions of journalism, they have more value than ever in an environment full of mis and disinformation on social networks.
Yeah, well, as long as colloquially we're still calling it Twitter, it'll always still be Twitter.
Always Twitter in my heart.
There you go. Brian, good to catch up with you. Thanks for taking some time this morning. Brian Stelter, author of Network of Lies, the epic saga of Fox News, Donald Trump, and the battle for American democracy. Thanks for taking the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. New NBA season, new arena potentially on the horizon. 76th place at Market East is a proposed indoor area and arena in the heart of Philadelphia with apartment units, retail stores, and of course, that arena. Investors are working to bring this $1.5 billion stadium to life. No cost to taxpayers is one of what's been touted about this, but it is facing opposition from nearby neighborhoods who think construction might reduce traffic to their business. Will the development be a slam dunk or is it a long shot? Big question here. For more on this, we've got David Adelman, who is the co-owner of my beloved Philadelphia 76ers and Darko Capital founder, here with us on Yahoo Finance. Look, you've got two native Greater Philadelphians here, so no doubt the Philadelphia fandom is running strong during the segment. But we got to ask, there has been a lot of pushback with this build out regarding some of the local residents, business owners that would be displaced here. How are you continuing to engage the city in conversations as well as local residents, business owners in the area?
Well, it's always good to have some Sixer fans here with me. But look, I think if you know Philadelphia, and you both know it, Philly is a creature of habit. We are not used to change. My vision is Philadelphians deserve great things. And so to be able to bring, as I tell everyone, 27 other NBA teams have downtown arenas. We're going to be number 28. So I'm not inventing the urban arena. But change is hard for some people. But what's unique about our project is we're taking a mall that is downtown in Philadelphia and repurposing one entertainment complex for another. And so, we're not displacing one resident, one business. We're taking a box of the mall and building the arena on top of that footprint, on top of the busiest subway station in Philadelphia.
David, walk us through just the process of how you draw up a project like a new arena. And when you talk about the fact that there has been some pushback, what are you doing to get some of those who are opposed to this idea on board?
Well, I think it's important in any large-scale development to listen. We've done over 85 community meetings with small business owners, large business owners, small community groups, nonprofits, to get feedback. And that feedback has continued to evolve our project. So when you talk about residential, we originally didn't have residential slated as part of the project, but the local community said we'd like some affordable housing. We're going to dedicate 20% of the new units as affordable housing units. Some people said, we want better access to the subway station. We're raising the bowl on the arena so that you can give a Market Street entrance to a subway station that currently only enters from the rear of the street. So I think the goal is to listen, hear people's perspective, and try and evolve your plan with that feedback.
David, who is involved in funding this? Because you'd mentioned, and the plans is that there would be no cost to taxpayers, but we know that there are some kind of mega profiles that could be involved in making sure that this is funded correctly, and especially at a time where we do know that the credit conditions and financing some of these larger complexes, larger constructs, that's coming at a premium here too. So, who are some of the big players that are really throwing some weight around in order to make this come to fruition?
Well, I'm really blessed to have two great partners in the Sixers, Josh Harris and David Blitzer, and they share my vision to do this and not take any city money. Let the city of Philadelphia has a lot of needs. Our school district has a lot of needs. And what's really exciting is that this is going to be privately funded by the three of us and the team. And most importantly, it's going to create $1.5 billion of net new taxes to the city, the school district, and the state. So not only are we not taking any funds, but we're actually giving back to the local community. And so we're very excited to be able to do that.
David, you're a longtime player in Philadelphia real estate specifically. You're CEO of Campus Apartments. Just give us a sense of what the landscape, what the industry is like today, given those headwinds, given some of the risks that we've been talking about now for quite some time.
Look, Philadelphia, just like every other city, is trying to get people back to work, back in the office. You have, unfortunately, some office buildings that are just not going to make it or on watch lists and things like that. But yet, we are seeing some other companies bring employees back. And I think that's how you kind of revitalize city. But, certainly higher interest rates is challenging for real estate. We're going to see that for a while. But, residential is still doing well. Multifamily is doing well. Industrial is doing well. So, it's not all doom and gloom, but there's certainly some challenges. But that's kind of what happens with these cycles.
Additionally here, I mean, you've also had a storied history in some venture capital projects as well here. When you think about those companies and where they may be looking for funding, where they're well capitalized right now, especially as a lot of small businesses, startups, as well as those companies that were in one of their series rounds, they're all coming out of this kind of financial and banking crisis that took place earlier this year and trying to figure out, okay, where do we tap our cash outlets? How are we making sure that we've got enough in lines of credit and ability to navigate through what's going to be an uncertain time as we're trying to figure out if we're going to see a shallow or mild recession even. What are you hearing from some of the CEOs, the founders of those companies that are trying to navigate this period right now?
What we're hearing is that, it's challenging, but I think, to a certain extent, and I've been saying this for the last couple of years, some of these founders were spoiled, candidly. Valuations were high, and they were giving investors like me and other funds, we were on a shot clock that you had 24 hours to match these terms or do this. And I think a little rationalization in the venture market is actually a healthy thing. But that said, you're going to see some companies not make it, and the strong companies will have to go back out for capital. Maybe the valuations change, but if you have a good business plan, a good management team, you kind of ride through that.
Just lastly here, we got to talk basketball with you since we have you. I mean, we'd be remiss if we didn't. What's up with this play-in tournament? Not the play-in tournament. What's up with the in-season tournament? Because it's been interesting as a fan to try and figure out, all right, what does this mean? What am I watching? What's the importance of this game? Because before it was just, hey, it's the regular season, and once we get past the All-Star break, that's when things really start to make sense. From your perspective as a co-owner, what is the pulse among owners of teams about this in-season tournament?
Well, and not to mention the weird colored courts you probably saw over the last week.
These are wild.
Teams, right?
It's crazy. It's like having to watch Boise State play like every night of the week. You got wild colors out there, David.
We had some wild colors we had in Philadelphia the other night, kind of this red and gray, and it was definitely different. But I think you said something really interesting that, people wait till after the All-Star break to start getting excited and think about things. And I think, the league thought, like, how do we create this kind of hub right now before the holidays and create some excitement? And so, what's better than a little competition? They created prize money for the coaching staff, for the players. And so a little bit of excitement, a little bit of energy, and kind of a, interesting part of the season. I think it's creative.
Sixers are off to a pretty good start here, David. We'll be rooting for them. David Adelman, co-owner of the Sixers and also Darko Capital founder. Thanks so much.
Thanks for having me.
Well, SpaceX's Starship rocket gets permission to lift off. Hopefully, the Federal Aviation Administration, the FAA, granting SpaceX permission to launch its Starship rocket. Regulators saying that the rocket has met all safety, environmental, policy, and financial requirements. This coming after the Starship rocket exploded during its first launch attempt back in April. More on this, Inez Ferre joining us here. Inez, so a huge step here for the company.
A huge step. This is so exciting because tomorrow is supposed to be that second launch. So this is significant. The test flight follows that first test flight, which Shauna was mentioning in April, which after a few minutes, that rocket exploded. It self-destructed in midair. The test, though, had been dubbed successful by industry watchers. They learned a lot from that flight test. There was damage to the launch pad. That's been fixed. They had some modifications that they had to do, some environmental concerns as well. So they had to reduce some sound waves and vibrations for this next upcoming test, and they had to pass a safety review from the FAA. Friday, tomorrow morning, a 2-hour window starting at 8 a.m. Eastern in Boca Chica, Texas. That is where the launch will take place. Now, Starship consists of the first stage booster called Super Heavy and the upper stage spacecraft called Starship. So if all goes well as planned, Super Heavy will come down in the Gulf of Mexico not too long after the launch, and the Starship upper stage, that will almost reach orbital velocity. Then it'll go down, splash down near Hawaii in the ocean. So the rocket is designed to be, by the way, fully reusable. And this is very significant. It's important because Starship is supposed to take American astronauts back to the moon in 2025. That's part of NASA's Artemis program. And then the big ultimate goal is to take people to Mars. It's designed to carry 100 people to Mars. NASA wants to be able to take people to Mars in early 2030s. But if anything we know about space travel, about the space technology, is that there are always delays.
We've also seen reports of Starlink spinning off as an IPO. What do we know about that, Inez?
Yeah, there was a report from Bloomberg earlier this week saying that Starlink, that the company was going to be, it's part of SpaceX, by the way, that they were taking initial steps to prepare Starlink to eventually go public, and that IPO could be delayed to 2025. Then Elon Musk on X had said that report was false. But look, the idea of spinning out Starlink, which is the unit which has satellites all over and to provide internet connectivity, fast internet connectivity to remote areas, that unit would be spun off for an IPO. That's been floating around for years now. So the question is, when will that happen? It's estimated by some reports that next year Starlink is bringing in $10 billion in sales. So that is a hefty amount. Also, Starlink just had signed a contract with the government of Mexico for $90 million to provide internet connectivity for people in Mexico. So when that happens, though, there are industry watchers that are saying when Starlink goes public, this will be a huge catalyst for anything that's space related as well. Because if you think that people are gung-ho for Tesla, that there's Tesla fans out there, there's certainly also space fans out there as well.
Yeah, it's going to be interesting to see, especially given the fact that Elon Musk has really been outspoken about whether or not he would take some of his other companies public, especially given history with the SEC in the past and run-ins there. Thanks so much for breaking this down for us, covering all things in the space. Inez Ferre.
Thank you.
Thanks so much. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Warren Buffett's Berkshire Hathaway has sold its stake in a handful of companies, including General Motors and Johnson & Johnson, and offloading smaller positions in companies like Procter & Gamble, according to its latest 13F filing. Berkshire's top three holdings remain Apple, Bank of America, and American Express. With more on what this signals about Buffett's shift in strategy, we're joined by Lee Munson, Portfolio Wealth Advisor, CIO, and President. What does this signal to you about perhaps the next leg of kind of prioritization in the Berkshire Hathaway portfolio?
Well, I think it tells you he likes energy, because despite the fact that he's been selling Chevron for, I think, 4 or 5 quarters in a row, he keeps adding to Occidental Petroleum. I also think it's a good lesson, not so much about what sectors he's in, right? I don't think Warren Buffett really thinks about it in that way. But it's one thing for sure, he's holding on to his Apple. You know why? Because they're a cash flow machine. He's holding on to his Bank of America. It's his second largest position. Why is he doing that? Why isn't he trimming that? Well, I'll tell you why. Because next year, if we get the bond rally the way everybody expects, their net profit, their net interest margins are going to go up and everybody's going to be very happy. So I think don't necessarily read into the sectors, but just more of where he's concentrated positions and where he's focused. He is focused on energy. And I think that that is a key thing going forward. I also think I want to point out that back in August of 2020, he started buying these Japanese trading companies. They're called Sogo Shoshas. And what they do is anything that they can make a buck off of trading from here to there, commodities, software, food, TVs, they do it. And I bought a little bit with Buffett, because it's a great way to follow a stock is to, put $5,000 into it and see what happens. And my analyst was telling me last night, he's like, we made a lot of money on these stocks. It's like, why didn't we just load the boat? Well, tell me about it. But we don't get that in the 13F because 13Fs don't show us international positions. So I think the real story is what the 13F doesn't tell us. And that is free cash flow, moving things from one place to another, and good quality companies, you go out 3 to 5 years and you're guaranteed to make money. So remember, it's all about those Japanese trading things. They're good valuations. They create free cash flow. It's a classic Buffett move. That's what I think the big story is.
So a win for Buffett, a win for you, at least when it comes to some of the holdings in regards to Japan. But Lee, what about the fact that Berkshire Hathaway is sitting on a record cash pile? Does that signal anything to retail investors?
Yeah, it should. It means be cautious. He doesn't see any screaming deals. I was talking with some people yesterday about how, the forward 12 blended month forecast on the Nasdaq is 28% growth or something ridiculous. A lot of that is based off of the AI bump this summer. It's based on a game to lose, not a game to win. Buffett likes good companies that you can buy super cheap. And so I think going into next year, if things were so easy, why isn't he getting that cash invested? I think he sees trouble next year. I think we see that valuations, once we get a little bit movement on interest rates, could make things interesting. And honestly, it's just hard to find good companies at a reasonable valuation. The fact that he's going to Japan to find things with a PE that's reasonable, I think tells us a lot about this market.
Lee, he didn't make changes to 4 of his top 5 holdings: Apple, Bank of America, which you touched on there, Coca-Cola, and American Express. Of those, any that you would own heading into 2024?
Yeah, let me tell you, Apple, come on. If you own the S&P, you own a bunch of Apple. So I think that's a company that's kind of, it's the poster child for a big monopoly. Nobody talks about their little hedge fund. Nobody talks about how Apple doesn't pay its suppliers till 60 days after they sell the product. We've never had a company like that. But it's a big part of the S&P, so I think that's something that you can hold. Bank of America, I can't believe I'm admitting that I own Bank of America. What a dog this year. But I'll tell you, when you think of Apple, that's like his S&P 500. When you think of Bank of America, that's his large cap value. I think those are the two winners of those two indexes. As far as Coca-Cola or American Express, Chevron, I'm ho-hum. If I wanted to own 3 things going forward, I'd probably own Apple, I'd own some Bank of America, I'd own some Occidental, and that's a great concentrated position, right, in those 3 names. But really, they represent sort of the broader markets and my philosophy that going into next year, you're going to have to barbell it between the real cheap value stuff like the B of A's, Bank of America, and the things that you just can't stop the growth, which let's represent with Apple. So that's an alternative to doing an index fund, right? Just buy the big winners and hope that Buffett knows what he's doing.
He's also a historical buyer of Disney, and you've got some interesting perspective on Disney as well, as you're shaking your head here. Go ahead, just give it to us.
I think Disney has structural problems going forward. I carried water for that company. It was my biggest loser since the lockdowns. And it's not just I'm upset about losing money. Hey, listen, stocks go up and down. I sat on those Japanese trading houses for 3 years before I really made the big money on it. The problem with Disney is when I look at my child and other children, there's so much more competition for content. When I was growing up, Disney was a premium thing. We all waited for things that they own now, like a Star Wars. But Star Wars doesn't have the moat. Marvel is losing its moat. And you see these Disney adults, but I'm looking at where are the Disney children? And so I think when you talk about Disney Plus and all that streaming, forget about it. I know Parks had a good quarter, But parks, I believe, are on a decline because there's just too much competition and it doesn't have the magic that it used to. Therefore, my thesis, the parks can always raise prices. That's gone. And because of that, I'm out of the stock. Hey, let somebody else try it in the 80s. Good luck to you. I hope it works out. I got other things I got to do.
Lee, that's a lot to unpack there. But let's start just with some of the changes, though, that Iger has implemented. We haven't given him too much time just in terms of what that turnaround strategy could potentially have Disney looking like in 2 to 4 years from now. Do you see any of those ideas that have been laid out from Iger over the last year potentially changing some of that momentum?
You know, I hope so, but I don't really think it's going to move the needle. I don't think the things that he's talked about are really exciting me, and think to myself, do I want to double down in the 80s after losing 30-40% over the last few years when it was a layup? I think the fact that, you know, people say, oh, he brought in the CFO because he was part of his old team. No, when you have to have, quote, the greatest CFO in corporate America to come in and run this company, I think that's a problem. This should be an easy company to manage. You have everything you want. You have the brand of the last 100 years. The problem is, it may not be the brand of the next 100 years. I think you have to wait on Disney. You know, never say never. I may be here a year from now. You know, maybe the stock's in the 60s, and I think, you know, it can work. But the fact that all of our hopes and dreams are riding on one guy who couldn't stay retired bothers me.
And I think it bothers a lot of other investors out there when you take a look at that stock price. Lee Munson, always great to talk to you. Portfolio Wealth Advisors, CIO and President. Thanks, Lee.
Thank you.
Stay tuned to here on Yahoo Finance. We've got all of your market action ahead. We'll be right back.
We've got much more coming up in our next hour. Starbucks workers on strike. Yahoo Finance's Brooke DePalma breaks down why workers are walking out and what the latest stoppage means in their fight for unionization.
Plus, former Federal Reserve Bank of Kansas City CEO and President Esther George on the latest inflationary data and what it could mean for the Fed's next steps.
You know what I learned is if Sazi ever gives you a stack of cash, make sure you count it all. There's only one 100
Never
on the top
trust
and
him.
bottom. Yeah.
That was a takeaway from today's show.
That's it.
All right, guys, that leaves us for today. Keep right here, Yahoo Finance. We got you covered for the rest of the day.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufa with Akiko Fujita. Here's what we're watching this morning. Another day, another retail earnings report. Walmart posted a beat in the third quarter, but a cautious outlook for the U.S. consumer is giving investors pause.
And worker walkout. Thousands of unionized Starbucks employees are striking over staffing and scheduling on a big promotional day for the company. What this means for the union's contract negotiations.
Plus, builder sentiment fell for the fourth consecutive month in November as higher mortgage rates hammer the housing industry. So is this still a seller's market? We'll discuss coming up.
But first, let's take a look at where the markets are trading right now. 90 minutes into the trading day, it is red arrows across the board. The market taking a bit of a breather here, you could say. The Dow down 87 points. The S&P 500 trading pretty flat, as is the Nasdaq right now. Some sectors we're watching very closely today. Energy, one of those, with oil down for the first time in 5 sessions. This coming on the back of latest inventory data pointing to higher inventory than expected, at least in U.S. oil here, or U.S. crude. You're seeing WTI down nearly 4% there. Brent crude also down about 3.5%. Let's also check in on Treasury yields. We're watching this one closely today on the back of some economic data. Import prices this morning coming in falling more than expected, down about 0.8% in October. We also saw jobless claims coming in at the highest levels in nearly 2 years. All of that pointing to the fact that inflation and higher rates finally starting to take hold here. And that's why you're seeing a pullback. The 5-year yield, 10-year yield, and the 30-year all down on the day. Well, results of this morning from retail giant Walmart giving investors some eagerly anticipated insight into the state of the consumer. It was a strong third quarter for Walmart, lifting its full year profit outlook for 2024, but shares still taking a hit after executives warned of near-term softness. And Rochelle, we are seeing a big move from Walmart, down about 7.5%. But let's keep in mind, this is a stock that hit an all-time high yesterday ahead of those results. So some things that investors are taking note of, those comments coming through from Doug McMillon, the CEO, about some period of deflation, as he described it, saying prices are starting to kind of stagnate here. His quote here saying that, well, that would put more unit pressure on us, Walmart. We welcome it because it's better for our customers. Of course, investors don't like it because that means less money coming in from Walmart.
It's true. And really that caution on the consumer really weighing on analysts here. But I mean, Walmart is one of those companies that is expected to ride out sort of a tighter walleted consumer than some of its competitors, especially if you think of how Target has performed. But they did also note, Doug McMillon noting some of that pullback in consumer spending and trading down, but still weathering it better. But seeing strength in groceries and health and wellness products continuing. Also noted that pricing in food still a concern, still seeing pockets of disinflation, but not as fast as he would like, especially when it comes to groceries. And also we saw from CFO Rainey, the takeaway is that they're seeing strength, seeing share gains versus others, but still pressure on the consumer. It's interesting because this is something that we knew was happening. We knew there was some softness that we were seeing in the consumer. And so it's interesting to see the stock being punished quite this hard. But as you mentioned, putting it in context against the backdrop of where it fared yesterday.
Yeah, maybe some profit taking that's also happening as well. We like to talk about Walmart specifically in the context of the consumer. But one thing I would note also coming through from these results, Walmart seeing a big pop here, at least on ad spend. This is a growing business in terms of revenue coming through from their ad business. That jumped about 26% year on year. So something else to watch as we see that comparison with Amazon increasingly.
Indeed, something always of a bellwether to watch with Walmart. Great stuff there. Okay, well, let's shift gears here. We're talking about President Biden. He's set to address executives gathered at the Asia Pacific Economic Cooperation, or APEC, CEO summit this morning. Now, that's one day after a key meeting with Chinese President Xi Jinping. Now, the 4-hour meeting between the leaders signaled little progress on key national security and economic issues, but it did deliver at least 2 significant agreements. Here with his take on the meeting, Yahoo Finance senior columnist Rick Newman. Rick, we knew expectations were low going in, so what do we know at this point?
I think it met low expectations. You could even say it may have exceeded low expectations by a little bit. And honestly, for people who are unnerved because they think bombs are just going off all over the world, well, here's something that actually seems to be maybe settling down even just by a little bit. So the 2 points of agreement were the United States and China are going to reestablish regular military communications. That's good news. Those got suspended. China stopped that basically after Nancy Pelosi visited Taiwan in 2022. So the Pentagon and the Chinese military will be talking to each other a little more frequently. And then there was agreement to cooperate rather in some ways on environmental issues and on green energy and addressing climate change. So that leaves a lot unaddressed. And I'm not sure we're going to see any what you might call backsliding in terms of, for example, the sanctions that the United States has put on shipment of high technology U.S. goods to China. I don't think that's going to go anywhere. I think that is going to stay put. I think China is going to remain militarily aggressive in the South China Sea, where it stakes a lot of territorial claims. But we heard the leaders of each nation saying, we recognize the fact that we do need to communicate with each other, and we intend to do that in the future. So a modest step forward.
Yeah, I mean, the fact that that is considered a step forward probably tells you where this relationship has been. One of the other, quote, deliverables, Rick, is this promise that China has made to help slow or at least stem the flow of fentanyl coming into the U.S. This is a promise that China made under the Trump administration as well. What's different this time?
Possibly nothing. I mean, you have to kind of ask yourself, how much can China stop the flow of fentanyl into the United States? It's not as if this is a sanctioned export. I mean, this is all black market smuggling, basically. A lot of this doesn't even come directly into the United States. It comes in through other places. So it goes to Latin America, and then it might be coming in through Mexico or the southeast border, or who knows? I mean, this stuff, this poison, gets into the United States many different ways. But again, you know, President Biden and President Xi are looking for things they can at least agree on in principle, and that is one of them. Just another important thing I would point out, Akiko, one of the things that really didn't come up publicly but is a major U.S. concern is Chinese support for Russia in the war against Ukraine. Let's not forget about that. It's still ongoing. China has not, as far as we know, been giving Russia large amounts of ammunition or military aid, but they have been helping in other ways. They've been buying a lot of Russian energy, probably helping with purchases of other Russian goods. And my guess is behind the scenes, there's a lot of conversation about that with the Chinese.
Yeah, not just about Russia, but also about China's communication with Iran, no doubt, as well. Rick Newman, thanks so much for breaking that down for us today.
Bye, guys.
Well, President Xi walked away from his meeting with President Biden on Wednesday, seemingly optimistic, saying it is not an option for the two countries to turn their backs on each other. He added, quote, planet Earth is big enough for the two countries to succeed. President Biden called the discussion some of the most productive he's had with Xi. So will these efforts last? Joining us now is Ambassador Kurt Tong, the Asia Group Managing Partner Executive Committee member. Kurt, it's always good to talk to you. You know, despite some of those optimistic declarations that were made publicly, in the press conference post-meeting, President Biden said he didn't necessarily change his characterization of Xi as a dictator. I mean, how would you characterize a 4-hour meeting between these two leaders, given how low the expectations were going in?
So I think you've accurately reported it, that the expectations were met. The objective of both sides was to establish a more stable conversation and put a floor under what at times over the past few years has seemed like a rapidly deteriorating relationship. And so they've been successful in reestablishing channels of communications, reaching some modest forward progress on some issues of concern to the United States. And I think looking forward, the goal is to have a relationship which is framed the way the United States wants it framed, which is primarily competitive, but not framed in such a way that it leads to a lot of downside risk. So managed competition is what both sides are seeking at this point, which is a very different state of affairs from some years ago, where the effort was to actually improve the relationship. Now I think it's just to stabilize it.
And to that point, Kurt, we looked at the Asia pivot when we had former President Obama. Then it was America first, trade wars, tariffs as well, and as a phase one trade deal that had a lot of promises, but not a lot of results. What do you think is going to be the defining narrative for the Biden administration and China? Especially, you have two countries focused on high tech as being the next leg of growth for both of their economies.
Right. So I think the punchline for the Biden administration, and this is one that Secretary Raimondo used again last night, is that the U.S. and China will compete where they must, and the U.S. will defend its interests where it must, but seek to work together and have an active economic relationship in any way that they can to the benefit of both nations. So it's very much a balance point, trying to strike, have a primarily competitive relationship with one of the most important trade and investment partners for the United States simultaneously, frankly, I think this was a very important meeting in setting that direction and maintaining that direction, at least for perhaps the next half year or so.
This was clearly a very choreographed meeting, and this wasn't just about playing to the U.S. audience as well as those executives that had been attendants of the APEC CEO Summit. It was also about playing to a domestic audience for Xi Jinping at a time when the slowdown has happened, right? There's still growth happening in China. It's not at sort of the 8% level that we saw previously. How would you assess where the economy is right now? I mean, how jittery is the footing for China? And ultimately, what does that mean for Xi Jinping in managing the country?
Absolutely. I think there's deep concern in Beijing about the state of the macroeconomy, a reassessment of its strengths and weaknesses, and a real sense that for China to continue to grow at a reasonable level to meet its development goals, it's going to need to accommodate foreign interests to a greater extent than its political system would naturally do. Political system is geared to be exclusionary, top-down, control-based, and highly politicized. That none of those are good features for an open and successful market economy. So we are feeling that there's a sense that there's a re-injection of this sense within China that the market needs to be treated with respect. Now, that's going to be the devil's in the details, and it's going to be extraordinarily difficult for foreign firms as well as Chinese firms to navigate through a complex environment. But there is a renewed sense just in the last few months that China needs to recalculate the degree to which it was prioritizing security over economics.
And Kurt, I have to ask you, because we've seen a lot of reshaping alliances, whether it was over how China's perceived interactions with Russia over its invasion in Ukraine, a lot of advanced technological pressures as well, especially we're seeing the US getting Australia, getting the EU on board as well. How does the reshaping of alliances affect what we see with multinational companies who are still interested in China, but this is a very different Chinese economy?
So businesses want to be left out of the conversation about issues like what to do about the Israel situation, about Ukraine, but they do get caught up in it when sanctions come into play, and when there are specific political actions that affect markets. In the U.S.-China relationship, the government sense, I think there was an important conversation yesterday of trying to find points on which the U.S. and China agree. For example, I think it's in the interest of both the U.S. and China that the situation in the Middle East not expand to become a broader conflagration that would limit energy exports and create real instability in the global economy. That's an interest for China. It's an interest for the United States. And so perhaps through communication, we can encourage China to play a somewhat more constructive role in that region.
Ambassador Kurt Tong, the Asia Group Managing Partner and Executive Committee member. Always good to get your perspective. Appreciate the time today.
Great to see you. Thank you.
Well, coming up, union efforts have exploded across industries. We're going to get the latest from the UAW's deal with GM, as well as Starbucks union's biggest strike ever. That's next. Workers at General Motors' largest U.S. factory in Arlington, Texas, have voted in favor of the tentative contract as voting procedures between the United Auto Workers Union and the big three companies continue. Let's bring in Yahoo Finance's Pras Subramanian to give us the details. Pras, where does this put things in terms of car makers being able to put the strike all behind them?
Well, for GM at least, it seems there's some positivity. They're on track for ratification. You mentioned that big plant in Arlington, Texas. They voted to approve the deal. So GM looking at now, we're on a 54% approval vote as of the moment. There's a couple plants that are not included in there, including in the UAW's vote tracker. There's a plant in Lansing Delta Township where they actually voted against the proposal, and they did not add those numbers yet to the actual tabulation, and also a few GM parts and distribution centers are not yet fully in there yet from a vote point of view. But it seems like it won't be enough to overturn. For GM, nearly 32,000 workers have voted out of a possible 47,000 total GM UAW members. So today's 4 p.m. deadline is looming here. We might see, that's the looming deadline for the vote. We're not necessarily going to know all the results until probably later tonight or maybe tomorrow. But at the moment right now, GM is sort of okay from an approval of the UAW tentative deal.
And Pras, after all it took to get here, what would happen if the overall vote is a no?
Right, so it doesn't go plant by plant. It's got to be an overall vote of the entire UAW membership for a manufacturer. If they vote a simple majority no, then what happens is that the leadership has to decide, what are we going to do here? Are we going to try to amend the pattern agreement? Are we going to try to do another vote? Are we going to go on strike again and try to actually extract more concessions that possibly the workers want? We saw with Mack Trucks, they actually rejected the deal, went on strike after about 30 days, and now they actually approved it. So that's a possibility, but that would be a very huge negative for GM and the industry. And I think everyone's trying to, on both sides, UAW leadership and GM leadership, they want to make sure this passes.
We'll certainly be watching that closely at 4 o'clock today. Thank you to our very own Pras Subramanian there. Well, it's one of Starbucks' biggest events of the year, Red Cup Day, where customers buy a drink and get a reusable holiday cup. The workers that voted to unionize are calling for the biggest strike in the company's history today. Yahoo Finance's Brooke DePalma joins us with those details. Brooke, what do we know so far?
Good morning, Rochelle. Well, that video that you just saw was taken by our team outside of the Starbucks Astor Place location here in New York City. And that store is still operating. But as you can see right there, that is that picket line in front where they're saying workers on strike don't cross the picket line. And then when a customer does walk through those doors to grab their drink or their food, they're met with that group of workers booing. Now, we know that this is part of a larger ask by the unionized group of Starbucks Workers United that they're asking employees walk off the job to protest over staffing, scheduling issues, and demand that Starbucks comes to the table to bargain. Now, the union is also asking colleges to cut ties with Starbucks. And in the background, beyond the strike, the Red Cup Rebellion, they're calling it today, non-unionized store workers recently filed more complaints on Wednesday against Starbucks here in New York City, claiming that the company violated the Fair Work Week law. Now, what that Work Week law is it requires fast food workers, once again here in New York City, be provided regular shifts, get paid premiums for scheduling changes, and clopenings, which is when workers have to work a night shift and a morning shift, and work regular hours before openings, and they cannot reduce hours by 15%. Now, once again, that is here in New York City, but that just was filed on Wednesday. But back to the Red Cup Rebellion, we know that Starbucks Workers United said that it's expecting roughly 200 stores to go on strike today.
Brooke, what is Starbucks saying in response to all this?
Yeah, Kiko, it really is a he say, she say kind of story. Starbucks is saying that right now, thousands of stores are open with no strikes for the Red Cup Day that they have each year. They only said only a few dozen stores have partners on strike, but nearly all of them are open. And so Starbucks is really saying that they continue to operate on this annual promotion day despite this noise. In addition to that, they said that promotional days may change some store patterns and traffic. So they're acknowledging that difference compared to regular days. They also added that retail leaders of the stores have the flexibility to adjust staffing to reflect the unique needs or demands that this sort of day promotes. In addition to that, they said that store schedules are created 3 weeks in advance to go along with partners as availability and flexibility. And they said that they do hire more staff for these type of days. And the big question here is if and when the bargaining will begin. But Starbucks spokesperson told Yahoo Finance that they call on Workers United to respond to our invitations to bargain contracts for the stores they represent. They added that Workers United hasn't agreed to meet to progress contract bargaining in more than 5 months. And so it really is, once again, a game of he say, she says, and when exactly we'll see this come to a resolution on both sides.
Continuing to see these workers' unions pushing, especially after UAW as well. Still seems to be the momentum here. Great stuff. Appreciate that update, our very own Brooke De Palma. Well, a slew of Fed officials are set to speak across the country today, weighing in on the state of the economy and the next Fed decision. We hear from expert, former Federal Reserve Bank of Kansas City CEO Esther George next. Lots of new data out this week, all pointing to potentially good news from the Fed and sending stocks rallying. Inflation was flat in October and retail sales were cooling. All positive indicators for the Fed, but investors are still holding their breath for a rate decision next month. Are we in the clear for a soft landing? Well, for more on this, Esther George, former Federal Reserve Bank of Kansas City CEO and president, is here. Thank you for joining us this morning. So obviously, hopes here for a soft landing. History would tell us odds not in the favor. I believe it's 1 out of 11 attempts in the last 60 years the Fed has managed to stick a soft landing here. What are your expectations?
Well, it's something we all hope for, don't we? Which is that everything operates smoothly. But the truth is, the Federal Reserve itself has acknowledged they've not yet landed. And by landing, I mean that they would have achieved their 2% inflation target. So I think everything points to smooth sailing today. But of course, they are a ways away from having achieved their target. So I think more to come for sure.
To that point, Esther, we did hear from the Fed chair last week saying that he's not quite sure that current monetary policy is restrictive enough to bring inflation back down to that 2% target. I've heard you say that you'd be happy to wait a little longer if you were still on the committee. I'm curious what questions you still have.
So when I think about the economy right now, we have a lot of rate hikes that are still in the pipeline. And I think we have yet to see those fully work their way through. And remember, at the same time, the economy is adjusting to the imbalances that we've seen coming out of the pandemic. So the combination of those things suggests to me that as long as the data is coming in a fashion that doesn't show the economy reaccelerating, that the Federal Reserve does have time to pause here and to look carefully to confirm the data that they're seeing and to make sure that they are in fact progressing toward that 2% target. So when the chairman says not yet sure that they're sufficiently restrictive, I think that is an indicator that more time is needed for them to gain confidence that they're headed in the right direction.
And Esther, I mean, even as we look at what we've seen with weekly jobless claims at a 3-month high, continuing jobless claims rising to the highest in almost 2 years, sort of these incremental indicators here. But what about some of these factors that are outside of the Fed's foray here? What are you watching in that space?
So the Federal Reserve, of course, has a dual mandate. It certainly is keeping its eye on inflation right now, but ensuring that it does so with an eye on the labor markets is also important to them. And of course, the labor market has been quite strong. We have seen people coming back in. The participation rate has improved over time. We're watching the jobless claims begin to inch up, but still very low right now. And so even as the unemployment rate has ticked up, it is still at a historically low rate. And I think watching this jobs data is going to be a very critical signal around how the economy is moving. It will be a lagging indicator for sure, but this has been an aspect of the economy during this post-pandemic period that has been particularly tight, has drawn people back in, which is good. But it is one of the signals that generally you watch as demand cools in an economy is how is that translating to employment.
Esther, really quickly here, looking to DC, I mean, it does appear as though a shutdown has been averted, but we did see Moody's downgrade the outlook for U.S. credit on the back of the uncertainty. When you think about the sheer amount of debt spending that's happening right now, what's more concerning to you, that or the gridlock that's happening in D.C. in terms of the impact that could have in the U.S., in the economy?
So I think you have to think of both of those as quite concerning. Obviously, good news that it appears there will not be a shutdown. Shutdowns are costly at many levels to our economy. And so that's good news. Being able to govern and to address these issues is going to be very important over the long term, though, because even as government sources like the Congressional Budget Office have already confirmed for some time, we are on an unsustainable path with the level of debt. And that must be addressed if generations to come are going to enjoy a standard of living in this country that we want. And so even though in the short term, we have averted a real, I think, jarring outcome by not having this government shut down, it is really critical, I think, that these issues of fiscal discipline be addressed in the near term.
Esther George, former Federal Reserve Bank of Kansas City CEO and president. It's great to get your perspective today. Appreciate the time. Well, let's take a look at where oil is trading today, because we have seen a big move to the downside in energy stocks on the back of a pullback in WTI crude and Brent crude. You see it down on the back of the latest inventory data. This comes as there's a report that says oil and gas giants could have paid for their share of damage caused by climate change and earned trillions of dollars in profit. That report coming through by Climate Analytics today. The estimated damage caused by carbon emissions from the top 25 companies would cost $20 trillion, but the company earned $30 trillion. More on this, let's bring in Yahoo Finance's Inez Ferre to break down the report for us today. Inez.
Yeah, Kiko. And as you said, so this report says that climate damages associated with oil and gas companies, which the report calls carbon majors, between 1985 and 2018 are estimated to have cost $20 trillion. But these companies made $30 trillion during that period. Now, the research was put out by the international think tank. It's called Climate Analytics. And basically, it says that if the oil majors had paid for the climate damages associated with CO2 emissions, they still would have made $10 trillion in profits. They list 25 oil companies which are included in this piece: Saudi Arabia's Aramco, Russia's government-owned oil producer Gazprom, the national Iranian oil company, and publicly traded companies like ExxonMobil, Shell, BP, and Chevron. Now, to be fair, oil companies have been diversifying to position themselves for the green transition. ExxonMobil is buying Denbury, that's a carbon capture operator. BP is targeting net zero by 2050. Shell is involved in wind energy, but that doesn't mean that these companies are giving up their main operations, which is oil and gas. And the report also calls out the oil majors, which last year announced record profits. Now, the study comes ahead of the UN's COP28 climate negotiations in Dubai, where negotiations over what countries where the most CO2 emissions should pay, that takes place in that meeting. And at last year's meeting, a special fund was announced to help countries coping with loss and damages from climate disasters. But those details still haven't been worked out, and it will likely be one of the points brought up at this year's talks.
And Inez, do you think from seeing these results, obviously for everyone to be able to see, do you think that will spur sort of perhaps more green initiatives here? Or do you think, as we've seen here, some of these energy companies will just sort of take it as if we're doing our part and we don't really need to be doing more?
Yeah, Rochelle. So as far as what we're seeing with crude inventories and crude prices right now, which had been mentioned at the top, for the fourth week, we are seeing that inventories are up with crude. So that's the highest level since August. So the whole tight supply narrative, that's being called into question right now. There's more supply than anticipated from what it looks like with those inventories here in the U.S. Also, there's been some technical levels which haven't been met. So that's why you're also seeing Brent crude prices lower, WTI crude prices lower. But certainly those inventories that are up, that were up last week, that is contributing to the downtrend that we're seeing with oil.
We'll continue to track that. Thank you, as always, for joining us. Yahoo Finance reporter Inez Ferre. Thank you, Inez. All right, coming up, a deep dive into the state of retail. Investors are reacting strongly to results from Macys and Walmart this morning. We'll discuss why next.
Well, it is time for our chart of the day. Luxury watch prices declining once again in the month of October. That's according to the Bloomberg Sundial Watch Index, which tracks prices for the 50 most traded watches in the secondary market. Prices for used Rolex and Patek Philippe watches fell almost 2% last month, its lowest level since 2021. The index is down 42% since its April market peak of last year. Now, we've heard time and time again this year the consumer remains resilient, but with the challenging economic environment we're currently facing, there's still little demand for pricey timepieces. Rochelle, it's tough for me to sort of loop this in with the rest of the consumer discussion and say that it's consumers who are pulling back on discretionary spending, because we have said even with the slowdown in the economy, usually luxury is a little more shielded. So what do we make of this pullback now? The fact that it is hitting sort of the highest of highest ends. People aren't buying their watches.
It's true. I mean, I'm not even in the Rolex Patek Philippe market conversation. That is not where my money is focused at all. But I mean, it's important to know that this is about the resale prices for Rolex and Patek Philippe. They have corrected sharply since their peak. It was interesting that their high was back at 42. It was 42% higher in April of 2022. In May is actually when they started having the crypto crash with Luna and Terra, because we're associating a lot of these
so
sort of
you think it's all the
new
crypto
money
that was kind of floating around?
I do, and now that things aren't where they were, people don't have, that's that thing that you show off is usually your watch to show that you've made it. And so once all that started to fall away and the crypto winter kicked in, you didn't see that as much. But I will say for the most popular brands of Rolex and Patek Philippe, they're still doing well in terms of the retail price, but it's that secondary market, the resale ones, that's fallen sharply here.
So crypto one theory, Rochelle, there's also an argument to be made about higher rates, right? I mean, I don't know. I don't have the cash to shell out for a Rolex watch, but you'd figure that if you're charging it up, then those rates are going to be a lot higher. That price tag is much higher.
It's true. I mean, it depends on if you're wearing it for show or if you're keeping it as an investment. So I guess that at this point, if you're using it as an investment, you're probably not as worried. But if you're trying to sell it off to try and, get a few coins to pay for your groceries now that you have to downtrade, and buy your groceries at Walmart, yeah, that's gonna hit you a lot harder.
I'm sticking to my Apple Watch. I'm happy with this one.
And I loved my Fitbit, but then when you have to charge it and do this and that, so I actually went back to just a regular timepiece. I do miss, seeing all my fitness goals and everything, but I'm a little bit old school and I just don't feel like having to charge every device and everything that I have in my life. But we'll see. I might get back on the Fitbit.
You're certainly not the only one, Rochelle. I have heard that complaint where let's just get back to something that doesn't need to be charged all the time.
It's true. It's becoming a lot. Well, we're shifting gears here because, of course, it's a big day for retail earnings. Shares of Walmart moving lower this morning after America's largest retailer cautioned near-term softness in consumer spending. Meanwhile, Macys is getting a boost from falling inventory levels, and that's despite a 7% decline in sales year over year. For a deeper dive into the company's latest earnings results and what's in store for retailers this holiday shopping season, we're joined by Oliver Chen, TD Cowen Senior Research Analyst. Good to have you on the show here, Oliver. So even though we'd already seen these indicators that the consumer was softening, why do you think, especially let's start with Walmart, that stock is being punished so much this morning?
Yeah, I think with Walmart, it was very solid numbers. Keep in mind the comp was 4.9% positive. Street was looking for 3.6. So great numbers here, a beat and raise. However, coming into the print, the valuation was fairly expensive. So it's a case where expectations were high, given the PE multiple of 22 times. On the other hand, Macys is only trading at a 5 times PE. So expectations were fairly low and the numbers were better than feared. But note, Macys did a negative 7% comp. What we're really seeing with this consumer is a stretched consumer, a consumer where discretionary products are under pressure and running negative, and you're putting more dollars in food and energy and interest rates, and that's really impacting the sentiment and psyche of the consumer.
Oliver, we heard from Doug McMillon today talk about a period of deflation that the company's going to have to manage through. Essentially, unit prices will be a little lower. How do you look at that right now? Are we talking a few months? Is this a bigger concern for other retailers too? What are you seeing in terms of pricing power and where consumers are willing to go?
Yeah, we just left the call with Walmart as well as Macy's, and what's happening is the price raises are softening, so disinflation. That has a negative impact on comp store sales because you're not getting the benefit of pricing. But that does have very positive impacts on the ability for the consumer to use those dollars to buy more stuff, such as clothes, apparel, home, hardlines. So overall, it's a positive for freeing up dollars for the consumer to discretionary products, but it's a negative for overall total comp store sales. So looking forward conceptually, retail needs to focus on selling more number of items or units. It needs to focus on traffic and getting people to walk into store or online, and conversion rates. That will be a major focus. But having disinflation, it really isn't a bad thing. So pluses and minuses in terms of thinking about how to model that and what it means for the stocks.
And I want to take a look at Macy's here, obviously seeing the stock being rewarded here this morning. What did you like out of that earnings report?
Yeah, Rochelle, you brought up great points. The inventory is in good shape. It's running very close to the sales, so well-positioned in freshness here. Also, a better than feared in terms of the comping, less negative than we expected or other people expected. We like Macy's. We have an outperform rating on Macy's. Our top ideas do include Walmart, Costco, Louis Vuitton, LVMH. But at Macy's, we're excited about getting the right stuff at the right place at the right time. So inventory management as well as pricing analytics. We also think there's an opportunity to improve the clothing. It really needs to be more relevant to Gen Z and younger customers, and they're working hard on that in private label. As we look ahead to holiday and Black Friday, and I hope everyone's out there shopping and investing in their wardrobes and buying for themselves and others, what will be big is gifting and beauty, and Macy's is well prepared for that too. They've been cautiously optimistic, and the word is cautious on their guidance. So this company has been executing relative to this cautious, reasonable guidance they've been offering. But trends are still negative. We really want to see growth. We really want to see margins on both sides.
Oliver, as we go into the holiday shopping season, there's certainly going to be a lot of focus on pricing, potential discounting, where consumers are. From a stock perspective, which one of these retailers you think offers the most value?
Yeah, what we continue to see at Kiko is this bifurcation theory. So owning very premium, great luxury, and Rochelle mentioned Patek and Rolex, because they're kind of at the upper echelon, but the LVMH portfolio, which includes Dior, Vuitton, and Sephora, and then also a customer that is obsessed with value and wants opening price points and is responding to promotions. So great ideas there include Walmart and Costco, because at Costco, you get the treasure hunt and you get extreme value. At Walmart, you get everyday low value. Plus, you're getting a tech play at Walmart. Don't forget about digital advertising, Walmart Plus, a marketplace model, and artificial intelligence. Those are big offensive moves too. But again, bifurcation, the bow tie thesis, buy high, buy low. In the middle, it's been tough. It's also been tough with the aspirational luxury consumer. Mm-hmm. So as we think about brands like Saint Laurent and Gucci or logo-heavy brands, quiet luxury has been working better. So that's what we see. I'm wearing Swatch Omega, so I'm a guy.
Well, by the way, Oliver, you've got a lot of our producers talking with the bags you have behind you on the wall.
I know, it's so distracting.
What are those bags?
Block those out. Well, I'm pretty obsessed with all things retail, and it's just a collection of stuff that I'm always using. Some of them are pre-loved, and some of them are limited edition, but retail's about change. Guys are a little lucky in that our bag trends don't change as rapidly as weekly, but I love stuff,
An analyst who lives what he covers, right? That's what you are, Oliver. Oliver Chen, TD Cowen Senior Research Analyst. Good to talk to you today. Appreciate the
Happy
time.
holidays. Have a great Thanksgiving and Black Friday. Thanks.
Go out and shop. That's the message from Oliver. Well, when it comes to retailers, Walmart is one of the biggest names in the U.S. In China, it is, of course, e-commerce giant Alibaba. So what are the latest earnings from these two giants tell us about the state of the consumer? Jared Lickery is here to break it all down for us today. Jared.
Yes, Akiko, it is tempting to compare retail giant Walmart to China's Alibaba. And if you're looking at the stock prices today, well, they're both having their worst days in a year. But the reasons why shareholders are selling today, they reflect very different dynamics at work in these two commerce monsters. Now, sales growth at Walmart, that slowed to 5.2 from 5.7%. But the real concern is a warning that Walmart is issuing about the U.S. consumer, Akiko. They're citing weakness that began a few weeks ago in late October. For all the talk of recession, employment has remained solid in the U.S. as consumer has been resilient. Now, Walmart is an important bellwether that could reflect potentially an early turn. Meanwhile, Alibaba's revenue growth, it also shrank, but it remains higher at 8.5%, and that's a nice pop. We had 13.9% last quarter. In fact, sales at Alibaba, that growth was north as 50% as recently as 2021. But in the post-reopening environment, that prior quarter was the high. Now, expectations for the next two reporting quarters are 9.8 and 8.5 respectively for Alibaba, and with Walmart, they are a bit lower at 3.1 and 3.5%. But the big two concerns at Alibaba are the slowing Chinese economy, along with the U.S. imposed export restrictions on the state-of-the-art semiconductors. Now, Baba management surprised investors by announcing they're shelving a plan to spin off their lucrative cloud business. And in the chart, we can see that long-run expectations about China GDP, those are going to shrink to about 3% in the next decade. And that is a far cry from the 10% growth earlier this century. The demographic impact of an aging population and mature middle class has its pros and its cons. And the con is that long-term growth necessarily moderates. But beyond all the demographics, both companies have been leaning heavily into e-commerce, with Walmart maintaining its online sales growth at 24%. That is the same as last quarter. And that's a far cry from the early days in the pandemic when their e-com sales were up 50 to 100% each for quarters, that was for 4 quarters over 1 year. Alibaba's, their proxy for e-commerce is Taobao and Tmall Group. They reported growth of 4.2%, and that's down from the 12.1% in the prior quarter. Baba is therefore trailing Walmart's e-com growth. As a U.S. giant, it's finally catching up. And despite all the headlines about soft China growth earlier this year, along with disappointing post-COVID reopening, Walmart sales and comparisons have been up healthy recently in China. They're up 18.6 in the reporting quarter, up slightly from the prior quarter, and down, though, from the 25.5% recorded 2 quarters ago. And finally, if we can compare the two stocks here, I was looking at the 2-day total here. You can see Alibaba is still down 9% today, Walmart down 7%. But let me just show you a 5-year chart. This encapsulates what happened over the pandemic. Alibaba here peaked in late 2020. In fact, that was the same year as the pandemic. And there were discussions at the time that Ant Financial was going to spin off. All kinds of theories about why that didn't happen. Jack Ma went missing, not getting into that whole drama. But the Chinese government has been openly antagonistic toward Chinese tech companies, and especially new listings, for several years. And I think we're seeing the results of that in the cyan line. So this is Baba, this is Walmart. Walmart kind of a consumer staple here in the US. Baba very much still a growth company over in China, but nevertheless, easy to find some common ground between the two retail giants.
Indeed, and I'll be interested to see how the Singles Day on November 11th shows up in the next quarter for Alibaba.
You bet, and they didn't break it out. They didn't break
it
it out, otherwise I would have talked about it.
See, I was heartbroken. I was looking for that, so I appreciate you keeping track of that. Thank you so much, Jared. All right, well, home builder confidence weakened in November despite easing mortgage rates. We look into the National Association of Home Builders report coming up next. Builder sentiment is down again this month, falling 6 points to 34 and marking the fourth consecutive monthly drop. That's according to the National Association of Home Builders. Sentiment levels now sit at their lowest level since December of 2022. Yahoo Finance's Danny Romero has those details. Hey, Danny.
Thanks to these higher mortgage rates that really weighed down builder sentiment this month. The index from the National Association of Home Builders came in worse than expected. Economists on the street were expecting the index to come in at 39. That didn't happen. It came in at 34. But it's important to highlight that this came in before the inflation report that came out on Tuesday that showed that inflation was moderating. That aside, home builders, these results really do highlight what smaller home builders are up against right now. Builders' outlook came in, also fell. They're expecting that sales conditions are going to be worse in the next 6 months. They also say that current sales conditions are, some of that outlook is looking a little grim, all thanks to mortgage rates. And to give you some context, at the beginning of this month, mortgage rates were hovering closer to that 8%. They've obviously come down since then. However, the push for sales to move up, builders have been offering incentives left and right. And the most common ones have been mortgage rate buy downs. That's when the builder upfronts costs to lower the rate down. That's been a very big popular one, not only with small home builders, but also the public home builders. And another incentive was price reductions. 36% of home builders have slashed some home price. And more than that, let's just, some context too is that some economists do expect that home builder sentiment will improve by the end of this year. But another thing to keep in mind is that the National Association of Home Builders is expecting that a 5% increase in single family housing starts for the end of next year as financial conditions and inflation improves.
Danny Romero with the breakdown there. Thanks so much for that. That does it for Rochelle and I in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.